Okay, you're recording. Hopefully this time it's going to work. I think this recording, this microphone works now. If you do notice that this quit's working, just let me know. Because sometimes I really don't. Last time I didn't run, it's being on all the time, but
we use that in Project Eval. We've been having a hard time. It just cut off 40 minutes on a very important class, so we've been having a lot of issues with this class.
I don't know. I tried to actually record this and then try to look at it. You can see here, I still do not see that being uploaded yet.
There's a light or something that tells you that it's recording both videos.
Yeah, it says it's recording. So, but you know, sometimes it's probably not working properly. I'll see. Oh, anyway, what I like to do then is go over the exam first, and I try to be careful in grading. But if I somehow, you know, misgraded whatever and something, just let me know, okay? And definitely would be happy to correct that. All right, James. Excuse me. So yeah. All right. Shane. Iron. Brian. Christopher Waters. Daniel there. Gene. Alright, we have a few people missing, so I might be here a little later. Alright. This one, right? Yeah. Okay. Let's go over that, alright? And see whether in terms of grade distribution, we have, I mean, the average is 85. Okay, average is 85. So we have about 13 or close to 14 people, I think, got higher than 80, and then a few just below 80, slightly below 80. So that's a good distribution. Okay, that was a good distribution. I know that. I wish everyone can get 90s or things like that, you know. But unfortunately, this turned out to be the case. Anyway, but as I said, if I misgraded your answer, just let me know. And all right, maybe I should just open Excel. Okay, I might just work on the board, and then maybe some of these things I just work on Excel. Just have here, do that. Bigger. Okay. All right. First question. I think a lot of questions are kind of similar, right, to the homework problems. Okay. You know, sometimes not exactly, but most of these are kind of similar. Anyway. So the first question is that what's the shareholders' equity? Shareholders' equity. What we're going to have to do is find out the total liabilities and then the total assets, right? And then just take the difference. So basically, 2011. I'm going to put it here, okay. All right, so part A. Okay, so we have 2011. Okay. Let's see. Okay, sure. All right, 2011 and 2012. 2011, we actually have to find the total asset. Total asset is equal to the sum of these 950 plus 4400, right? Okay. So everyone has that in front of you. So it's 950 plus 4400, so it's 5350. And then 2012 is 56. So wait a second. No, wait a second. I'm looking at yeah. All right. So 2011. I'm talking 2011 there, right? So that's 5350 minus the total liability of 2810. Right. So that gives us this minus the other number. So it's 2540. So this actually is the owner's equity for 2011. Right. For 2012, it should be calculated similarly. So we have the total amount of asset is 5606, and the total liability is 3402. So it's equal to 20. Wait a second, I got one number off. All right, so it's 2204. I didn't see any problem with that part. Okay, what's the change in net working capital? Right. So the thing is that we need to find out the working capital. For B, the working capital equals to the current asset minus the current liability. So in that case, the current asset is equal to what? For 2011, is equal to 950. Right? To look at that balance sheet. So 2011, the current asset is 950 minus then the current liability of 410. That equals to 540. Okay, 540, and that's for 2011. I probably should put it in there. It doesn't really matter, right? So you know what I meant.
You just lost the microphone.
Huh?
You just lost the microphone.
Lost the microphone? Okay, let's see here. Came back. I don't know what happened. All right. Try to save some energy, save some battery, I suppose. Okay. All right, so that's 2011. 2012 is basically equals to, okay, I might see whether I have made a mistake in grading and stuff like that. So let me know. There's a possibility, all right? Okay. Well,
You lost it again.
lost it again.
Yeah. I've got my voice recorder going if you just want to rely on that.
Okay. Yeah. The thing is that sometimes people want to go back and forth, then they have to go back and forth with that recorder too. So it's not going to be as convenient as this one. But anyway, I'll give it a try. If it's lost it, then turn it back on. So I don't know what happened. It's probably not the battery problem. All right. Okay. So for this one here, it should be equal to 1006 minus what? 602. The current liability lost again. All right. So that should be 404, right? 404. So the change in working capital should be 404 minus 540. Okay, so the change in working capital equal to the numbers 404 minus 540. So there's a decrease in the working capital, right? Okay, decrease of working capital. And this is important because otherwise you have plus minus when you want to calculate the cash flows. It's going to be a little different. So that's the part B. Part C, what's the taxable income? Taxable income, we just have to use the income statement, the revenue minus the cost of goods sold, depreciation, all these things. So for part C, what we have there is 14200. Lost again. I don't think I like to do this.
Do we still get the voice? Will it still record on Katura without that thing?
I have no idea.
It did. I guess it wouldn't matter.
Yeah, it usually gets the video. What I can do, if anybody cares, what I do in Dr. Keller's class is I literally screen capture the video,
Right.
and then I sync it with my audio and I post it to YouTube.
Oh, okay. Okay, that'd be great.
Yeah. It'll take me a couple days, but I can do it.
Okay, if there's no audio, then we just have to do that. Okay, appreciate it.
Thank you.
Well, the thing is that I'll let Dr. Sharma know this is not working. It shouldn't be the battery problem though. Maybe I give it a try. The battery problem. Well, I think last time I just tried to figure out how to get the battery out. And give it another try. If it doesn't work, and that's it. All right, back to business. So 14200 and then 7120, and interest payments. I think the interest payment, depreciation 1200, and then minus 216. Let's just face straightforward stuff. Okay, so that should be equal to this number minus this, minus this, minus that. So the taxable income 5664, and then the taxes paid should be equal to this number multiplied by the tax rate of 35%. Should be equal to 982.4. I mean, I didn't see much problem. Okay, but then next part D, company purchased $2,000 net fixed asset. How much fixed asset did the big gas sell? This actually there's a little problem, because one of the things that we actually have is that when you have a fixed asset, you do have depreciation. So I think most people do not take that depreciation into consideration. Okay, that's the part. Asset, because there's a change in that. So because we actually have the values on book, right? Because these are the financial statement that's on book. So we just have to the depreciation will have to be factored in, right? Factored in. So in that case, then the net fixed asset actually increased by 200. Right? Net fixed asset increased by 200 because it increased from 4,400 to 4,600. If you look at the net fixed asset, the third line in the balance sheet on the left-hand side. But you know, we actually have the sold purchased 2,000. So there's an increase of 2,000, right? So there's an increase of 2,000 basically. So what we have here is 2,000 minus then the 200, okay? And then this is already known, but then we actually have a 1,200 depreciation as well. So that's the part most people missed. So actually sold 600. So the difference is actually 600. Right? A few people actually got that part. But if you missed that little thing, it's no big deal. Right? You just maybe a couple points, stuff like that, 1 point or something, or a couple points. Depends on. I think it's probably just 1 point. But then the cash flow. Okay, cash flow from the operation. Cash flow from operation. Basically, that should be equal to the taxable income 5664 minus the tax 1982.4. All right, and then plus the depreciation. This is the amount that we got from the cash flow from the operation. From operation. Okay, but then we have to have the other cash flows, right? The cash flow from changing the working capital. So this is delta. And then this actually is a negative number, 136. So that should be in there, right? Because some of the amount actually has been tied up. So the cash has been tied up because of that working capital. So there's you know, the, let's see here. Well, actually it's a decrease. So it's sort of like freed up, right? It's a decrease, it's negative. So it's not really tied up, it's a decrease because originally we have a working capital of 540, but then we have 404. So there's a free up of $136 working capital, right? So that should add to the cash flow. And then the financing, right? The financing part is that we actually purchased the $2,000, right? But then we actually sold $600, right? So we should have negative 1,400, right? Sold 600, purchased 2,000. So we actually, for financing, we actually have negative 1,400. So the cash flow actually it should be 33. Wait a second. Did I get it right? No, It's not right because I added up. So this should be this number, cash flow from operation, minus the change in working capital. So that shouldn't be the sum. It should be this number, cash flow from operation, minus the change in working capital, and then plus the cash flow from financing. Right? So that should be equal to 3617.6. Right? So I think we have a little bit of things here, right, from this part. Right? So that's the net cash flow. The last part, there wasn't really a problem. Debt increased by 400, so we actually paid off 200. Right? Okay, company raised $600. Right? So, but the only debt only increased by $400. So, $200 must be paid off. So, that's the first question.
Can you comment on why the change in working capital is subtracted from
It's
cash?
subtracted because basically what we are talking about cash flow. For example, if you have an inventory, right? Right. Suppose that we have inventory. Suppose the inventory increased by $200. Okay. What happened is that the value of the inventory is essentially tied to the cash. Right? You should have sold this, but haven't sold that yet. So $200 actually worth the cash is tied up in that inventory. So the amount of cash available in hand actually is reduced by $200. Right? If you sold that $200 inventory, then you receive that $200. Suppose that happened in the same time period, then you would actually have that $200 in hand. Make sense? That's why if you have more tied up in the working capital, that just means that you use the cash for this working capital. So the cash actually is going to be reduced by that amount. This is why we minus the increase in the working capital or the change in the working capital. Right?
Okay.
Okay.
Can you click on the cell with the 3600 real quick?
This one here?
Yeah.
Okay. Is equal to 4881.6 minus the negative number, which is actually at, plus 136. And then minus that 1400. Yeah, I think it's off a little bit, right, from here. I think there's, here or there maybe just a little tiny thing, one little item, didn't take into consideration. So I actually had 1 or 2 points deducted from that. All right, I'm gonna just do this. Okay, so for the second question, we have little problems. Okay, not a whole lot. Most people got that correctly. First part is that we actually start with $1,000 at the very beginning, and for the first 8 years, all right, then the interest rate on that account was 6%. And afterwards, it's only 4% for the remaining years because we have 21 years, right, basically. So for the remaining years, that's 13 years. So how much that's going to be? So that should be equal to 1,000 times 1 plus 0.06 to the power 8. All right, so that's how much you're going to accumulate at the end of the 8 years. And then we have to continue accumulate at an interest rate of 4% for the remaining 13 years. And that's going to give you 2653. Okay. All right, so that's how we put that part. All right. So that's 26, that's 2. Okay. I think pretty much everybody got that part. The second one, what's the value of the perpetuity that pays $100 every 3 months forever? Okay, now we have a little bit of things here. Okay, so basically, there's a little twist here. So how do we calculate the perpetuity? Basically, the formula for the perpetuity is that the payment, right, or whatever the receipt or payment divided by the interest rate per period. Okay, so the twist is basically to be able to calculate the interest rate per period. Right. So what we have here is that we actually have 6%. This is the APR, but then this is paid every 3 months. So what we're going to have to do is to calculate the periodic interest rate. Right. So for the first part, to be or not to be, for this one here is to get 0.046 divided by 4, right, to get the periodic interest rate divided by 4. So it's 1.5%. Then that value should be equal to 100 divided by 0.015. So that's equal to 667. Okay. 667. All right. Yeah.
About this 0.06 by 4, that gives you, I mean, PV by R is EAR, right? Equivalent annual rate, right? When we calculate perpetuity, that is C by R.
Equivalent annuity?
No, sorry. Equivalent annual rate, EAR.
Oh, effective?
Effective, I'm sorry.
Effective, yeah, annual effective rate,
so
right?
that is like 1 plus this number raised to power.
Yeah, well, if you are looking at equivalent, if you are trying to calculate the effective rate, right? Okay, now that's going to be a little different. How do you calculate that? Because this is the 4 times, right? So in that case, what you're going to have to do is to equal to, if you want to calculate, but this question didn't ask us to do that, all right? Oh, I see what you were asked about. We really cannot use that because that's effective. How much you are paying, depend on the compounding in that case, right? For that particular year. Well, if you want to calculate that, that would be equal to what? 1 plus 0.015, right? 4 periods, right? Minus 1.
Minus 1.
Yeah, that would be the one you're going to calculate.
So we cannot use this for.
No, we're not doing that because that's the rate that you are paying actually at 1.5%. So we're going to use that actual rate, not effective. Effective actually is the annual rate, right? On an annual basis. Here we're not talking about per period. Per period. So we shouldn't use that interest rate. Should just use 1.5%. Okay. Number 3. We have $1 million by the time you retire 50 years. Okay, there's an inflation rate of 3%. So what will the real value of $1 million be by the time you retire in terms of today? So basically, it just has to discount by the interest by the inflation rate to get the real rate, right? So we actually we're going to have 1 million divided by 1 plus 0.03 to the power 50, right? So that's what we're going to have. And this is equal to 1 million, okay, divided by 1 plus 0.03 to the power 50 equal to 228,107. So that is the real value of $1 million by the time you retire in terms of today's dollar. So that's 3A. Okay, 3B. Okay, 3B. Well, while real annuity in today's dollar will 1 million support if the real interest rate at retirement is 2% and the annuity must last for 20 years. So we are talking about a real annuity, right? Real annuity with $1 support. We have already calculated the real value of the $1 million at that time, right? So what I'm going to have to do is essentially how much that $228,000 is going to be able to support, right? Because we have to use it real to do that. So in that case, what we're going to have to use several things, right? You can use C times that 1 over 0.02, which is the 2% interest rate, real interest rate, right? Basically, this is what I meant. We can simply use that, use this formula here. C times 1 divided by 0.02 minus 1 over 0.02, 1 plus 0.02, and then we have 20 years, right? And this is equal to 228,107 because we're talking about the real returns. And C will be equal to 3950. Okay, 3950. So that's the real annuity amount. Now, if we use the Excel formula to do that, we actually have a payment, right, function equals to 0.02 and 20 and then 228,107. Right. So basically, this would be payment Okay, 0.02, 20, 228, 107. Right, so that equal to 13,950.28 is the same amount. The same amount. I think most people got that part. Number 4, I think number 4 probably, actually, you know what, I've seen a lot of creative answers, which is good. You know, sometimes, you know, for the engineers, you like to do it. Use a lot, you know, I just see several people actually use this. Actually, it's kind of surprised. I didn't really expect you guys to do that, by the way. But I actually turned out to be fine. You know, the results seem to be fine. Not exact, but you know, it's kind of close. And you actually try to use this Excel to calculate that $5,000, right, increase by 5% each year. I don't know how many years you went on. Until infinity, right? I think some people stopped at like 20 years, 30 years. You should probably continue. Your answer is going to be a lot closer, right? So I think that's the engineer way of doing things, probably. Okay, but the analytical way is something different, probably. Okay, what I mean by that? And you know, like analytically, this question is a little different from the question we had, right? Because we actually have cash flow at the end of the year would be $5,000. Okay, cash flow $5,000. But then the cash flow in the future years is expected to grow indefinitely at the annual rate of 5%. Now we have a discount rate of 10%. So one of the things we are thinking about is that that amount, the $5,000 has to be discounted each year. But in the meantime, it grows at the 5 year, right? 5%, I'm sorry. Has to be discounted by 10%, it grows at the 5%. So what's the net? Basically, you can think about that way, right? The net is 5%. So one of the things you can think without actually going into the analytical solution is, hey, the net actually is 5% each year. You have to discount it, right? So one way you can do it is, what is that amount equal to? It would be 5,000 divided by 0.5. Right, so that would be $100,000, right? $100,000. Now that would be, of course, this is like intuitively, right? Intuitively. But there are other ways of doing that, okay? One way of doing that is to use, now I did see a couple people actually use that formula, okay? This is actually pretty good for using that formula because you were thinking about it. That's the exact same thing we did. Remember when we calculate the return on equity, right? In a growth that formula, we actually had the dividend divided by what? The price plus the growth rate. Okay, what is this growth rate? This is the dividend growth rate actually. Well, you think about that, that problem is the same thing as this, right? What we have here is dividend is the payment, $5,000. So in this case, RE, you have $5,000 here. Price is the current value, the present value actually, right? So this price is the present value of the future dividend streams. So in that sense, it is the same as the present value of the perpetuity in that case. Okay, this is something we want to calculate. We don't know what the value is at this point. But what's the G? G is the growth rate of that dividend, right? It's the growth rate of dividend, which is equal to 0.05. And then this, of course, we know is a discount rate, right? Cost of capital, return on equity, discount rate. So it's 0.10. So you can actually solve for P, and this actually P would be equal to $10,000. It's essentially the same thing as what I just erased. It's the same thing, right? Okay, so that's another way of doing that, right? The third way of doing that is actually the engineering way of doing that, right? Just you have to keep going, never stop, okay? Don't stop at 20 or 30. All right, so that's another way. But then that's approximation. I probably deducted a couple points or 1 or 2 points if your answer is not close enough. If your answer is close enough, I probably just said okay. All right, there's another way that is essentially related to how we obtain this formula. How we obtain this formula. So this is something we all have to do. Basically, if we are looking at a cash flow, so this is what we have. So period 0, period 1, 2, 3, 4, and just keep going. And the period 0, we have $80,000. And then we have $5,000 here, and $5,000 multiplied by 1 plus 0.05, and here have $5,000 multiplied by 1 plus 0.05 squared. You can just keep going, right? So you actually have 1 plus G to the power, okay? Depends on the number of years. in that case then, we actually we want to calculate the amount, the growing amount, how much that's going to be in terms of the present value. So in that case, suppose we don't have $5,000, but just $1. In that case, we're going to have 1 plus R. That would be for the first year, right? For the second year, would be 1. Okay, second year would be 1 plus G divided by 1 plus R to the power 2, right? We discount that. You grow by 5%. And then for the third year, what you're going to have is 1 plus G to the power 2 divided by discount times discount factor, right? We keep going forever. Now, how much this is equal to? Well, what we can do is set this equal to, say, this is equal to x, right? Equal to x. Then what we're going to have to do is essentially solve for what the x value is, right? What the x value is. Well, how do we do that? One of the things we can do is we can multiply both sides by 1 plus r. So in this case here, we have 1 plus r times x. So this becomes 1. And this one here becomes 1 plus g and 1 plus r, right? Okay? And then plus 1 plus g squared plus divided by 1 plus r to the power 2. So we can have this going forever. All right? Okay, what is this equal to then? Well, this actually is pretty straightforward because this side here is 1 plus. You can see here, if you factor out 1 plus g, right? You factor out 1 plus g. Then the rest of these term, starting from this term on, will be equal to 1 over 1 plus r plus 1 plus g, 1 plus r to the power 2. You're going to have that. What is this equal to?
X.
This is equal to x, right? That will be equal to x. So in that case, then what you're going to have is 1 plus r times x equal to 1 plus g x. Then you're going to get that the dividend growth model, basically, right? Dividend growth model. So what you're going to have is the x equal to 1 over r minus g. Okay, so it's $1 growing at g% discounted by r interest rate. That's how much you're going to get, right? The present value of it. All right, it's the same thing. So no matter what you do it, you should get the same amount, $100,000, right? $100,000. All right, so what's the net present value? That's very straightforward because we spent $80,000 at the very beginning, and the present value of perpetuity is $100,000. So the net present value is $20,000, right? So $20,000. So for that part 4, okay, the net present value equals to 100,000 minus 80,000. That should be $20,000. Okay, so that is this part. For part A, 4A. 4B. Okay, what's the 4B then? What is then? 4B says, what's the project IRR? Well, this actually you can use that computer to do that. But you know, if we actually use this formula, then the derivation would be a lot easier. Okay, it would be a lot easier. Why? Because in that case we have $80,000. Okay, plus that $5,000 divided by, now this IRR is not known. We don't know that value. But minus the G, which is 0.05, right? This should be equal to 0. This should be equal to 0. And we just have to solve for the IRR in this case. So this IRR actually is equal to, if you solve it, equal to 11.25%. 11.25%. Right, so there's an analytical solution. Right? We don't have to use that Excel to do that. All right. Well, the microphone seemed to work, right? So it's probably just the battery problem, the low battery. All right. So that's 4B. Okay, 4B. So that's the 11.25%. Okay. Any questions so far, guys? Okay, next question. Next question, I think pretty much everybody got that. Okay. So basically, number 5, it asks us for the net present value A and B. That's straightforward, right? Net present value. Do you still have your copy with you?
Exam?
Yeah.
Oh, I
Did you?
turned mine in electronically.
Yeah, I know. Do you still have that copy with you, right?
Oh, yeah.
Okay.
Do you need it?
Yeah, well, probably eventually I will need it.
Okay, I'll bring it next class.
Okay, okay. Yeah. So, well, you probably need to have a copy here and take a look at it, right?
Huh?
You're going to probably take a look at it because we're going over that.
Oh, thank you.
Yeah. So, okay. So, let's see here. Number 5. Number 5. So we have 2 projects, A and B. And that's just straightforward. Okay, that's straightforward. I think there's no problem. Let me just skip that, right? Okay, no problem. I think everybody got that part. All right, if you did miss a little bit, just yeah, I don't remember seeing anyone did that wrong. Okay. Number 6. Number 6, I think most people got that right, and I still had maybe 2 or 3 people who didn't do that correctly. Right, because if you remember something that we did for the homework problems, okay, the homework problem, and a lot of us actually calculate net present value for both of these, you know, say investment projects or 2 options. And that's not really the right way of doing that. We really can't calculate the net present value. Why we cannot calculate net present value? Because these things last for different years, right? Different periods. If they have the same periods, the number of years, same periods, then we can calculate net present value. But they are not the same, right? So that's why we actually need to calculate the equivalent annual annuity value, right? Either it's the cost or the benefit. That's why we need to do that. So in this case here, what we need to do is to, this is the same kind of problem, right?
Yeah.
You just change the years on it.
Yeah. Do we have that problem for the homework?
Yeah.
Yeah, so we don't need to do that. Okay. All right, so it's the same problem. Okay, same problem. All right, for the next one, I think we actually, this is the same kind of problem that I actually, we actually went over. Is that right? I mean, yeah, it's just, you probably didn't expect that. Okay, so that's actually the same problem. I think one of the things that we had, the problems we actually had, the one problem we had is to calculate the cash flow. And I think we had some problems with that cash flow. So let me spend some time working on that. I think this is actually, I need to go over that. Number 7. All right, so basically we have year first, and then we have revenue, and have expense, and then we have working capital, and then we have depreciation, then cash flow, right? Cash flow. How can we calculate the cash flow? Well, let's just work on one thing. Now somehow I kind of find it kind of interesting because for some people, you calculate the cash flow for years 1, 2, 3 correctly, but for the number 4, 4th year, somehow the number is different. So you got you know, probably somewhere you missed something. Sometimes I couldn't figure that out. Probably didn't spend enough time trying to figure out why you did that wrong. All right, so we have the 40, 30, 20, 10. That's the revenue. But then the expense, as we said, it is the expected to be equal to 40% of the revenue, right? So that's 16, and then 12, and 8, that's 4. Okay, working capital, we have, of course, 20% of the revenue. That's what we said in the following year, right? In the following year. Yeah, in the following year. So for this one here is what? It's 6, 4, 2, 0. So which means then if we put in a different year, we need to add in another year there, right? So year is 0, 1, 2, 3, 4. Okay, so revenue here is 0, and there's since the 0, working capital is 8. Depreciation, oh, I think that's why. Okay, I think probably some people did not factor this in. That's why the last year was a little different. All right. The depreciation is a straight line depreciation. So it is 40 divided by 4. I mean 50 divided by 4. 50 divided by 4. No, 45. 45 divided by 4. So it's 11.25. No, not first, not this year, 0. 11.25, 11.25, 11.25. Okay, so what's the cash flow? Cash flow should be equal to, well, let's just use the one, you don't have to use that formula. What we can do is try to calculate the profit first, right? We have 40% tax rate. So in that case, we have taxable income, 40 minus 16 minus the depreciation, right? So that is the taxable income. 40 revenue minus expense minus depreciation. That gives us the taxable income. And then times 0.6. That is actually the after-tax income, right? After-tax income. And then plus the depreciation of 11.25. Okay? And then what we're going to have to do is to plus, or I should say minus, right? Okay? Minus the change in working capital. What's the change in working capital? It's 628, right? So what we're going to have is 6 minus 8. That's the change in working capital. So that gives us, I probably should have used the numbers instead of using, I mean, you should use the formula correctly. Just use the reference instead of using numbers. So that'd be equal to 20.9 for the first year. Maybe let me change that, okay? Because that case then I can't carry through. So that should be equal to 40 minus expenditure there, cost there, minus this, okay? The times 0.6, and then plus depreciation. Did I get it right? Yeah. Plus depreciation, okay? And then minus change in working capital, this minus previous year's working capital. All right, so we have 20.9. Then we carry out this for the rest of the years. We should get the following cash flows. I think for a lot of us, somehow this became like 8.1, so you missed that 2. It's probably because of the working capital, change in working capital, I think. Okay.
I'm sorry, can you go back to the cash flow equation?
This one here?
Yeah, maybe.
Yeah, it should be equal to the taxable income, right? Taxable income, D, 3640 minus 16, and minus depreciation. That gives us the taxable income. And then multiplied by after-tax rate, right? It's 0.6. It's 1 minus 0.4. 1 minus the tax rate. And then plus depreciation, right? Plus depreciation. And then minus the change in working capital. That'll give us the. I think most people probably just missed this. There are a few people who missed the calculation of these things somehow. Okay, so that is the working capital. That's part B actually. It's part B, cash flow. Now what is the initial investment? I think a few people missed that. Initial investment includes the $45,000, right? Initially. And also the working capital. Working capital is the initial investment. So that should be equal to 53. That's the initial investment. The net present value, once you calculate these things, then net present value can be calculated relatively easily, right? So we just have to have negative 53, that's the year 0, and then we have 20.9, 17.3. So just use the net present value, this in here, plus net present value of these numbers here, and you get, I'm going to have an interest rate. Interest rate is 12%, 0.12, right? Now, so is 4,377 is 4.38, 4.377 something. No, 4,377. That's what it is. Okay. The IRR is relatively easy to calculate though. IRR. So if you put in a cash flow net 53 here, negative 53. So what's the IRR? IRR equal to this. Should be 7.5%. Okay. Number 8, we actually have a little problem with number 8. Okay. Various places. Look at the question. Total market value of LNG gas is 6 million, and then total value of debt is 4 million. And the treasurer estimates that the beta of the stock currently is 1.4, and that the expected risk premium on the market. Now this is something here. Okay, if you read that question carefully, the expected risk premium on the market is 10%. This is the market risk premium. What is the market risk premium? Market risk premium equals to, yeah, this is something. You gotta understand that, because these are terms that we use. These are standard terms. So the market risk premium is already the risk premium. It's already the market return, right? RM minus the risk-free rate. This is 10%. So if you got this wrong, then your answers will be different. Okay, actually it would be incorrect. By the way, what's the risk-free rate? Looks like we wouldn't have any risk-free rate anymore, right? Almost. Actually, just like risk-free rate, just what? There's no risk of default, but that's the T-bill, right? But looks like we actually had a huge problem with that. All right, so what is the required rate of return on the stock? Required rate of return on the stock. This is return on equity, basically, right? It's return on equity. So what can we do? Well, there's no dividend or anything here, so you really cannot use a dividend growth model or things like that, right, to calculate return on equity. One thing, we don't have a discount cash flow here, right? So you don't have cash flow, so there's no way you can use cash flow. So only thing we can do is calculate the return on equity by using the CAPM model, right? That's the only thing we can do here, because we don't have other choices. So you're going to have risk-free rate plus the beta RM minus R free rate, and the risk-free rate is 4%. Beta is 1.2%, 1.2 times the 10% here. Okay, 10%, because this is already the market risk premium. I think we had some problems with this calculation. So this is already 16%. So this number is 16%. Number B, what is the beta of the company's existing portfolio of an asset? Now we're talking about company as an asset. It's not just the equity, right? We're talking about asset. So that includes the bonds as well, okay, the debt as well. So in that case, we're looking at the company, basically the beta. So it is a weighted average of the beta of the asset, each of the assets, right? So basically we have debt over the total amount of assets, okay, multiplied by the beta of the debt, plus the asset, or I should say the equity, over the asset amount. So that is the ratio of the equity multiplied by the beta of the equity, right? So that is basically the company's asset. I mean the beta. So what is the D? It doesn't really matter here, right? One thing actually is this part. This is actually the big part, right? How do we know the D of the beta? Beta of the debt. Well, this is the debt is basically, in this case here, right, is not varying with respect to the market returns. Okay, it's not changing with the market conditions, basically. Whatever that is, you're going to have to pay, right? So, make sense?
I know we talked about this briefly after the test, so...
Yeah. What's the beta? Beta is essentially see how that changes responding to the market conditions, right?
Right. Well, can I tell you the way that I interpret it?
Sure, absolutely.
The beta of the debt is the response to the bond market or the T-bill. Because you said it's virtually risk-free.
Right.
So in my mind, I said whatever the T-bill rate is,
right,
that's the debt rate. And so that's a beta of 1, is it not?
No,
so if the T-bill rate is now 5%, then the company's risk-free rate is 5%.
Okay. So, but the thing is then, there may be a little bit of, Now let's think about that. The thing is that if you actually have a market rate, you're talking about just the debt market, right? The debt market. The debt market, say the. I think there's some reason there. Because if you are thinking about that risk-free rate, right? In that case, in this particular case, is the I think that's probably reasonable. If this is totally tied to the market, I mean the debt, right, yield.
Right.
If that's the case, if you make that assumption, that might be just reasonable. It says 1% is just the 1, the beta is equal to 1, because whatever that changes, right, is the same as the market rate.
Yeah, I think both interpretations are entirely reasonable.
Yeah, I think it's
when you said what you said, it makes sense to me. I just didn't have to.
Yeah, but I think if that you said that, I think it's reasonable. I don't know whether the rest of you guys actually made that assumption or not. If you did, okay, I'm fine with giving back the credit. That's not a problem.
I thought it meant that the data you gave us didn't change, so it's still 1.2.
It's going to be hard because that 1.2 is the equity beta, the equity beta. That's not going to be really related to the beta on the debt. So that's not going to be equal to 1.2 though. It's going to be, this is going to be 1.2. This is probably not going to be 1. It's going to be hard to justify. It's probably 1.2. I'm sorry, Gene?
The debt, so you're saying 1.2 is the BE over there?
The BE is 1.2.
Yeah. So I was assuming that this would be 0, so...
This is 0. It's fine. If this is 0, if you assume this is 0, that's fine.
And the 1.2, like the two added together is what I thought you wanted.
Okay, I try to understand what you're saying
I
here.
thought you wanted this B over here, so you would have 0 plus the 1.2.
But this actually, there's a weight.
Okay.
It's a weighted average. So you cannot apply to 100% of total debt, total assets. So there's, I think that's 6%, right? 6%, 6 over 10. So it'll have to be multiplied by 1.2. Yeah, but that's close enough. It's close enough.
Trying to understand.
Yeah, that's good. But there's a weighted average. Okay, so that should be 0.72. There's one more thing. Basically, it is the beta. If you interpret the variation of the bond yield to the bond market variations, if you interpret beta as that, then you could say it's 1. But if you really want to interpret that variation of the return on debt to the equity market variations, that would be a little different. But anyway, we'll probably want to get into the details.
If that was true, would you have even asked us to calculate the
Yeah. Okay, let's just put that aside.
Okay.
We don't want to get into too much of details of that thing. I think it's reasonable to assume that to be equal to 1 in that case. Number C, estimate the weighted average cost of capital, assume a tax rate of 40%. That's, I think it's fairly straightforward to do that, right? Basically, just use that weighted average. Yeah, Gene?
So, what you're saying, the total market value, the $6 million, is the asset or the equity?
Well, the market value is the equity.
So,
Total value of a debt is $4 million.
okay.
Because we said that, right? Market value of the company.
I thought debt and asset was equal to the total market value.
Okay, that's your interpretation. Okay. Well, you know what? From reading that question, there's no way to tell, probably, right?
That's how I do it.
Okay. Total market value. Yeah, I should probably a little bit more specific. Maybe I should have said total market value of the NNG gas equity That probably will make that a little clearer. Okay, that's fine. If you interpret that the 6 as the total amount, which means then the equity amount would be equal to 2 million,
That's
right?
what I did.
Okay, if you did that, then your weight is going to be different.
Yeah.
Okay, that's fine. You know, if you did that, just point it out to me. I will make changes. Yeah. But in my mind, when I was making that question, I was thinking about it explicitly.
Because your mind knows the
Yeah,
answer.
but it wasn't really reflected in that question. So I can't be a good lawyer, you know. So okay, so that's okay. We can do that. So if we estimate a weighted average cost capital, assuming tax rate of 40%. So what we're going to do is to have, I'm going to continue to assume 40% in this case, okay? So in that case here we have 0.4 times the 4% return on that times 1 minus that tax rate of what? Let me see here. 40%, 0.4. Okay? Plus the 60% of equity times return on equity, which is equal to the what? Return on equity is something we calculated before, 16%, right?
It's 0.16.
Oh, 0.16, yeah. 16%.
Yes.
Okay. So that should be equal to 10.56%. If we assume that 40%, I mean, you know what I meant. 46% of weights. If you have different weights, then the number will be different. Number D, estimated discount rate for expansion of a company's present business. Well, what the question is that if you are expanding the company and then the things are the same, what's the discount rate? The discount rate should be the same as the weighted average cost of capital, right? If you have the exact same kind of business. So it should be equal to 10.56. All right, that's just a concept question, basically.
Sorry, can you explain that again?
Okay. Basically, what we are saying is that the company is expanding its current line of business, which is they're going to have the same kind of degree of risk or whatever the component of the asset, whatever. Everything's the same. So that should be just equals to cost of capital, the company's cost of capital, right? The discount rate is the cost of capital of the company. So that is equal to the part calculating part C. Discount rate should be the cost of capital, is the cost of capital, just a different name for that. Number E, suppose the company wants to diversify into the manufacture rose-colored glasses, the beta of the company, optical manufacturer with no debt outstanding, the 1.4. What is the required rate of return on that new venture? Okay, new venture. In this case here, we just have to change what? Change the beta, right? Change the beta. Beta is no longer to be equal to 1.4, so the equity part is going to be a little different, right? It's going to be different, okay? The debt is still going to be the same. So what happens then is you're going to have 0.4 is the weight times 0.04. That's the return on debt, and times 1 minus the tax rate, okay? And then plus 60% times that. Now you're going to have to use that 0.04, the CAPM model 1.4, use a 1.4 instead of 1.2 times 10% market risk premium. Okay, that should be the one that we use. Right? Just the difference here is to change to 1.4, right? Change the 1.2 into 1.4.
So that's basically saying that the beta of the asset is
It changes. It changes. Yeah, that's the beta. We actually had one example, similar one example on the slides, I believe, something like that.
So if it says assuming the company will not issue an additional debt, if it did issue any additional debt, how would we approach that?
Let's see here. What is required? Assume the company will not issue any additional debt. If you assume additional debt, in that case, then the weights will be different.
So you have to calculate
A new weight,
over
debt
asset.
weights, right? Basically, the market's capital structure is going to be different, so the weights are going to be different. And there's a possibility if the rates, in reality, what happens if you issue a new debt, right? And then the yield is different, then that's going to affect your weighted average cost of capital. It will affect both of these things. It's not going to affect the equity part, though. The equity part is going to be the same. the return on equity is going to be the same. Okay. And this is the case that sometimes when you look at companies, just like a financing situation, they may have issued different debt, right? Different notes, and you could have 3 or 4 different notes, right? In that case, which means then it should, like this case, there's only one, like 4% is the return on debt, but they could have issued a different one. For example, if you have a new investment, then you could have issued new debt, then it will probably carry a different yield, right? In that case, then different return. Then you're going to have to calculate differently. Just weight these things differently. It's still going to be the weighted average cost of capital. All right, so that's going to be equal to, what's the problem with this? It's probably because of the brackets. Yeah, so 11.76. Okay, last question. And the last question, basically, I think just get some basic idea. I think most people got it fine. Even though maybe 1 or 2 points deduct somewhere, but I think that's generally okay. So we're gonna have revenue, okay, have expense, operating expense, drilling expense. Pretty much everybody got that part anyway. So SE method. FC method. Okay, so the revenue is 10, and another one is 10, right? Okay, why 10 million? Why we have 100,000 barrels of oil at price of $100 per barrel. So that gives us $10 million, okay, $10 million for revenue, okay. And then operating expense is somewhere, it's 4. Yeah, cost is 4. So it's -4, okay, -4. So I'm going to add them up. So that's why I said -4. How about a drilling expense? Drilling expense. Well, it really depends on successful efforts, right? Because successful efforts, we actually have, how many dry holes we have? 3, right? 3 dry holes. And then cost of drilling was $1 million each. So that's -3. But if we use the FC method, then the drilling expense is equal to 0. Right? So that's the major difference. And I think everybody got that part. Okay, pretty much everybody. So what is then the income, the net income? The net income in this case is 3, and in this case here is 6. Right? So that's what it is. And then you're going to have, not net income, but it is the pre-tax income. That's what I should say. Okay, so the pre-tax income. And then the tax rate at 35%. This is equal to 1.05. This one equals to 2.1. So the net income in this case is equal to 1.95 and then 3.9. Okay, I think pretty much everybody got that. Okay. All right. Now the question is about the asset. Okay, it's about an asset. All right. So one thing we're going to have to say here is the long-term asset. Under the SE method, what's the long-term asset? Is 7, right? Because you actually have 7 successful wells, and they each at the $1 million. So you have 7. But then, if under this one here, FC method, we actually have $10 million. Everyone's going to be treated as that. Okay. How about the current asset then? All right, current asset. One thing we do know is that the current asset includes what? The cash, right? In this case here, it's operating revenue. Right, the net income would be, so you get a 1.95, this is something we actually will have, right? 3.9, that will be some of the asset we have, right? Okay, another way, if you assume it could be there, is that the investment amount, if this depends on your assumption. If your assumption is such that at the very beginning of the period, you actually had a current asset, which is equal to that $10 million, right, the investment amount. Okay, if you make that assumption, then the current asset is going to decrease by $10 million in that case, right? But you don't have to have that assumption, right? If you have that assumption, which means this could be the case, right? This could be the case because you're going to have a drop in the amount of the cash that you have.
Even if you're assuming 0 entries for beginning of year assets. and liabilities and equities?
Yeah, I think this is based on that. We don't have any other information, so we have to just make that assumption of the zero current asset and current liabilities at the beginning. Okay, right? Or you can say, well, the current asset at that point there is this, right? So we were only talking about the asset, I believe.
So no matter what the beginning amount is, you're just assuming a decrease based on the investment.
Yeah, you can say that. Yeah, right. I mean, unless you make some other assumptions, yeah, you know, you specify that, right? But
do
we
you
don't
have to do this?
You don't have to do this. You don't have to do this. You don't have to do this. Okay. And for the other parts, like what's mentioned, general more volatile income and asset valuation when there's an increased amount of the exposure. We actually have that curve, on the slides. Actually, I was expecting people to say a few words about that. Okay, some people actually said that. I mean, of course, the SE method, right? So you have increasing degree amount of explorations that certainly would make that income, all these things more volatile. I mean, since that we actually talked about it. Right? So if you just mention a little bit. Okay, all right. If you do have some problems, things like that, or you find that's we discussed, okay, and definitely we'll just make the corrections, right? Which basically means the average value is going to be. The mean score is going to be higher. The mean score is going to be higher.
What's the mean score?
The mean score is 85. Standing at this point is 85. So I think it's pretty good. I think everybody performed pretty good. Okay, even though you may not be satisfied with some of these things, I think it's probably just because somehow it's the little details. Right? Basically, everybody. I understand that everybody understands the principle pretty well, but sometimes it just comes down to details. Unfortunately, the devils are already in the details. So we need to know the little details and stuff. So, any questions, guys?
I have one.
Yes.
On part A of number 8.
Yes.
Again, why did we assume 0% of risk grade?
Which percent? I'm sorry. Assuming what percent?
The very top equation.
Yeah.
You said the RM minus RF is 10%.
Oh, we're not assuming it. Okay, what that said is, if you look at that 10%, 10% is expected risk premium on the market.
Okay.
This is what the expected risk premium on the market. I think it's probably because the term threw you off probably. Yeah. So it is 10%. Well, there's one thing though, there's another term. We said the company's stocks risk premium. Okay, what's company's stocks risk premium? This is a little different from the risk premium on the market return. Right, company's risk premium
12.
is 12. Why is 12? That involves a 1.2 exactly. That the company's
Oh yeah, it's a beta times the market.
the company's that includes this thing, whole thing. That's what we call the company's equity risk premium. That includes the 1.2, but this is the market. Yeah, so that, I know that sometimes it's just a term, right? We're not really very, very familiar with the term probably, but that's what it is, unfortunately. Okay. Maybe we should take a break at this point and then we'll come back for the new stuff. Okay. You know what, guys? I think I'd like to keep this with me. Okay. And can I have that back? And Damien, you bring that back next time. And if you still have questions, whatever, we can talk about it. And the final exam, actually, is not going to be cumulative. So it's going to be on the materials after this exam. It's going to be after that. What's that? 35%. I forgot.
Midterms 35.
And it turns 35%. 50 to how much? I can put that in there. I'm not going to have all that. So this is your plan. Yeah. Oh, okay. Okay, you know what? Let me just deal with that, right? Put that from there and come to, over there. Let's just try it. I know you guys actually have some.
There is always some.
I'm going to attach just a note for
You know what? Why don't we just come over here? Explain that to me. I can get that point to you on the spot. Yeah, yeah, let's do that. Let me turn this thing off. That off. This is off.
You said you made the same assumption that the total
Yeah.
rate is like
Yeah,
Yeah, I remember that really. I stared at that for a second, and I remember I literally made this.
Yeah, I mean, if you
Yeah.
did that, I mean, you could say
Because
this.
assets is equal to debt plus equity is what was in the note, so I
Yeah.
just,
I should have made that more
Even
explicit.
if you give just hydraulic.
I was thinking about that's the only, you know, but of course you are right. If you think that way, that's
So you sort it out as per date, right?
okay, let's quiz that first.
Yeah, okay.
Okay. I'm going to use my pen, correct that, and now I'm going to put that on there before I forget about it. Just happens. Sometimes I forget about it. All right. Is the last question? I think it's 8. 8. Okay, let's see. Let me go through that.
Okay, give it
Okay. Yeah. So is that mostly consistent?
The audio video.
Yeah.
Oh, there is still one document. Okay, whenever you put it, just.
Okay, yeah, it'll take me.
That's fine.
It'll take me a day or so after it's available for download.
Yeah.
I literally have to.
So that's
do a
the
live
reason
screen
why,
capture,
right?
Which takes 3 hours.
Return.
And then bring it into
So this is
a
all right, right?
production
So,
studio software. and sync
I'm
up
gonna get back.
the tracks. It takes a little while.
It's totally fine, right?
Oh, you have to
Fine.
Can I come after?
Yes.
I can't remember. Because like my likelihood of actually sitting down and watching this is well, if it's homework.
Basically, so this is nothing here. So it's gonna be this.
You're only going to miss about an hour and a half.
I feel bad.
I make changes right after this. So once I finish this one now.
mine was electronic, it was that same assumption.
Yeah, let me pull it out. It's gonna be learn. Oh, you.
Yeah.
Yeah,
Okay, you
it's
can
not-
look at that.
Yeah,
It's no
it's like
problem.
this little-
I haven't been able to remember this for a long time. I don't know whether you are or you are.
You were too fast anyways.
Yeah, I might just take off.
It
Or
should be,
this one here.
yeah.
I feel bad leaving class early.
And Dropbox.
I don't want to sit here and just hack my lungs out while everyone else is listening. Is that? At least I can watch the video.
Yeah. Hopefully, we get the call.
Yeah, I think that's the same thing. 5.3, that's the number you got.
Yeah, that's what I
What about others?
did. Oh, I didn't have time to finish the others.
Okay.
80.
So I
Oh,
forgot
yeah, calculations.
Yeah.
Is this your copy or is it? Oh, okay.
And then I cut off 5 points off.
Yeah.
Okay, so this is on the first
No,
one.
my-
I'll probably not be able to.
Yeah, but then I did.
Yeah, no, this is the. So weighted average. Okay. That's part. Bye. That's okay. Part A, that's fine. So what is this part? It's part B.
Yeah.
Part B. Did you get part C? You didn't get part C or something, right?
I did A, B.
A, B. You didn't have C. You have C.
I didn't have.
Yeah, I think you had a
start
C.
number.
You didn't
Yeah,
have
I
D.
had C.
You
I
didn't have
have-
D
I didn't have
and
D and E, yeah.
Yes, that's correct. So I'm probably not going to be able to give too much to you. So
Yeah, that's fine.
I'll give you back 2 points.
Okay. Thank you.
So I'll do that.
Okay, so I made the assumption that beta
What
was
is
1.
that?
So
Yes.
that changes B.
Okay. So this is finance.
Oh, I also made the assumption that 6 was the total.
That's fine.
So that changes these ratios.
That's fine, so this is fine now. So this is the same thing there, this should be fine there.
Mhm.
Okay, this is the same thing, okay?
Yeah, E, I didn't really understand what you were talking
Okay.
about. I didn't even
Okay.
understand the explanation.
Okay. Yeah, the thing is that, for this part here, because we still are talking about the required rate of return. Required rate of return is just the weighted average cost of capital, it's the same thing. So what we're gonna have to do is you calculate this, not just return on equity.
Okay.
This
Well,
is
let me-
only return on equity, and then,
Well, let me play a little devil's advocate here.
yes,
Since if you're not issuing any new debt,
right?
are you issuing new equity to finance this expansion?
Let me see whether we actually have anything here, set something, diverse, clarify. You don't have to though, there's nothing said, anything about issuing new equity.
Okay.
No, it didn't
So
say-
you could do it from
Yeah,
existing.
you could do that with existing, because a lot of times when you actually have your own capital, right, you can
Okay.
do that. I mean, there's no indication of any new issuance, whatever, but, this is gonna be probably just one point, and then you're gonna get, through that. This part here is not.
Yeah. Yeah, that's fine.
Yeah, yeah.
I definitely didn't understand it. I just
Yeah.
wanted your clarification.
Yeah, I mean, this is, it is, what should I say, it has to be the weighted average cost of capital, not just the equity. Return on equity is not going to be enough, because we are talking about, the whole thing, right? What is that? The new venture.
I just still wanted to fully understand what you're
Sure.
saying.
Sure.
So it's, you use the weighted average cost of capital here, and what changes is, so you take the new beta and you get a new RE, and then you put it in.
RE, yeah, you get a new RE, but then the data will still be the same, because in this case here, the business is a little more risky. You cannot use the 1.2.
Right. So
to
you,
calculate that.
okay, so you calculate,
Calculate the weighted average cost of capital. Okay, that's what we need to do. Basically, it's still same. This part is still the same.
this will stay the same.
This is the
That
same
changes
except for RE
because of the new
because
beta.
of the new beta.
Okay,
Yeah, so everything else is the same. except
Got it.
for that, the new beta.
okay, thank you.
All right. Yeah.
Could I call one more question?
Sure. Yes. Give me 1 second, please. Before let me do that. Very quickly. Sure. Okay.
So, in question one, there was part B where we had to calculate the investment.
Do you know which question?
Yeah, for question one, part B.
Oh, part 1.
Part B. I mean, I know I got it wrong,
Mhm.
but this, we went over the cash flow, but the investment part, like investment,
Yeah.
so how do we calculate
Okay.
investment?
Well, that's really, you purchased 2,000,
Mhm.
right? Basically, you purchased there will be outlay of the cash.
Correct.
So that's a negative 200.
Right.
2,000.
2,000, yeah.
2,000. But then the company also sold how much? Sorry. Oh, sold $600. That's based on.
So, what's the final formula for investment? Like,
Investment is basically like, if you make a new investment, that's going to decrease the cash flow.
Okay.
But if you divest, okay, or sell any kind of asset, then that's going to be inflow. When you sell it, you receive cash.
Okay.
So that's basically, if you talk about cash flow related to investment, there are two kinds basically. Either spend money or receive money. When you spend money, that's when you buy new stuff, new investment. When you receive cash, then that's when you actually sell the asset.
Okay.
Divestation.
So once we get the cash flow, then we have to subtract 3,000 from that.
Yeah, basically what happens is that you actually have a reduction of the $2,000, and $600 is what we actually have here. There's an increase in the $2,000 asset, right? But then the net fixed asset from this only increased by 200. Okay, so 2,000 minus 200, you have 18. But then you're gonna have to count the 12 on the depreciation.
Okay.
So in that case, then you actually have $600. You sold $600. That's why I got that $600 there.
Okay.
You sold $600, but if you didn't have that 1,200, then you're gonna have 18 here.
Okay.
It's gonna be different. So that's where that $600 difference comes from.
Okay.
So when you sold 600, you received $600. That's the increase. And the decrease, so that's why we actually have a decrease of $1,400 next year.
Oh, okay. And this is the investment, right?
The net then would be from the operation plus that change in working capital here, and then the investment part, the financing part. Get that part. Okay. I mean, this is just sometimes a little detail.
Yeah. I got
But that's
that.
that's yours. Good job.
I have a question.
Yes. Well, again, right?
No.
Oh, no.
But yes, obviously, but this is the last question.
Right.
Why we don't take into consideration the oil that we discover, but we don't take it from the underground? The asset.
The asset, well, this actually is kind of special rule for the oil and gas companies. The reserve asset is not counted as their assets. It's not showing up on the balance sheet. It's not there. Now, if you look at like Chesapeake and all these companies, their reserve values are not really showing up.
Very close. If they go home on Saturday, think you can finish it up.
You count their assets. Well, yeah, it depends how you look at it. You can have short-term asset or long-term asset, right? Okay, say in terms of accounting terms, you have current assets. That's one, right? Then you also have long-term assets here, right? The current asset includes what? It includes the cash, okay? The common capital cash, that's part of the current asset. So it's part of the asset. Like inventory, okay, it's also the asset, right? And then you have other things, receivables, that's also asset. Okay, so that's an asset, right? But then the long-term asset, the one that we actually calculated, that's also part of the asset. Yeah, the thing that we did is, for example, if you drill say well, right, and in like a successful effort case, you actually have 107 successful, and each of you is actually $1 million, that means your asset increased by $7 million. Now, that is exactly related to the expense incurred. The value is related to the value spent drilling. Now, later on, what I'm going to do is the value of acreages, the value of the reserves. The value of reserves is not showing up on the balance sheet. It's not showing up there. So what is the value of acreage? Now we're gonna look at that later on how we're gonna be able to calculate that. So that's a little bit sometimes confusing, but that's just what the rule says. So that's not showing up in there.
Correct.
Oh, you say that dollar is different. Oh.
This is for just a general flow of pipe. Viscosity is a function of whatever fluid is used. This right here is totally different. Yeah, just Most of those equations are derived based on drilling pipe, drilling formula. It's not the same as if you don't do on surface hydraulics. It's not the same as So you said the final is not.
Final is going to be on the materials after that exam. So starting from today. So it's not cumulative.
Wow. Okay.
Maybe I said something. I don't know whether I said anything on the syllabus. You know, whether the
No, I
cumulative
just
or
said
not.
it's 35% of grade.
Final?
Yeah.
35%. 35% midterm, right?
It's 40. Let me take a look.
40% final.
I believe so, yes.
Okay. Yeah, whatever that said there is 40%, and yeah, I just say 40%. Okay, let's see here where I should put this in. Midterm exam formula sheet. All right, I'm going to put that explanation on along with that midterm exam formula sheet. So.
Unless you made, did you make an adjustment to how you were going to grade class? I can't remember. I would have wrote it in my notes, but.
But adjustment to what?
Did we talk about an adjustment on how you were going to grade the class? I can't remember. No, we're going to another class. Okay. Well, I remember in someone's class in the evening, I thought we talked about possible adjustment. I can't remember what that was.
Adjustment to what? Adjustment to?
Well, there was something on the syllabus, and maybe it would be graded differently. But if you don't recollect that, then forget I even said that.
Grade differently? Are you talking about
like
the weights?
Taking 5%, putting it somewhere else or something. I don't care. I mean, I'm expecting 40%.
I mean, usually what I do is I make some adjustment, you know, on the test scores. You know, as you can see that I just make some adjustment.
Yeah.
But then when I assign final grades, probably I will do a little bit of that. Depends. You know,
Okay.
depends on the overall.
Maybe that was last semester. Was that last semester we did that? Or? I bet it was.
I have a short memory.
Me too.
Maybe.
It might have been last semester.
Because at the very beginning, maybe the weights was different.
I think the students
probably,
you agreed to do something.
Yeah, probably something like that.
Okay.
Yeah, it could be the case. Yeah.
Yeah. Over 20 hospitalization.
All right. Oh, let me try to. All right. I'm going to let me see here. Put that, upload that, and then we're going to start a new. Okay, let me just upload this explanation onto midterm exam explanation. That spreadsheet file onto that D2L. It's under. Let's see here. It's still uploading. It's onto. Shouldn't take that long though. Probably because I can close it. Let me cancel that and then just reload it. Yeah, that should be very, very quick. Okay, so it's uploaded into that folder, midterm exam formula sheet in that folder. So if you want to take a look at that, all right. Okay, let's get started with the new stuff. All right, so financial statement analysis. All right, financial statement analysis. Well, we actually have a few things left. Right, one of this, of course, financial statement analysis, like ratios, financial ratios. A lot of times of course, when we look at the company's financial performance, we'll look at that. So there's a little bit more detailed analysis of various aspects. Okay. You know what? Before I forget, can I ask for a piece of paper for that attendance sheet? Okay. Thank you, Eric. And then, we actually have the variations for specific sectors. But before we do that, there's one sector. I think the next section is about variation of stocks. So we're going to talk about the general principles of stock variations. Right? So that will be the next section. And then we have specific segments, the variation methods. So, but you're going to utilize basic principles and apply this principle to the oil gas business. All right, so let's just get started on this part here. This should be pretty straightforward. I mean, it's a short amount. So we're going to look at the annual report, 10K, and look at the ratios. And the focus of this particular section is the ratios, a lot of different ratios. And actually, homework number 4, I think. The next one, I'm gonna give you guys homework number 4. It's actually among the slides. If you look at that, you know what I'm talking about. Okay. Example: annual report. So if you look at the annual report by Chesapeake, we can kind of glance through this annual report. If you haven't really looked at the annual report at all, and look at the Chesapeake annual report, you have lots of all the information. You look at the company's basic business. Okay. You look at the financial information. You have everything there, right? So basically, let me just bone up this a little bit. Where is that? Yeah, make that bigger. Hey, what? Edit? No. Kind of weird. There should be a place that I can enlarge this, right? Tools. Range. That's interesting. That should be a thing too. Anyway, it's really hard for you guys to see that, so I'm not going to really just go through that. I talk about a lot of different things, including some of the basic financial information. Anyway, you're going to go through that in the homework assignment. Actually, I'm going to ask you guys to do that. Right? To just answer a few questions, right? By looking through the 10K report or annual report, to extract some information. So you're going to do a little bit of reading. So you will get kind of familiar with the annual report. So that's the purpose. Okay, that's the purpose of assigning that homework. So I'm not going to go through that. So you're going to go through that. All right. I'll get back to the annual report. So I actually have a couple of links here and talking about different kinds of financial statements. All right. So 3 things from the annual report: income statement, balance sheets, and the cash flow statement. This is just standard type of thing. Right. Income statement, we already know that, right? Provide what the business is doing. Is that profitable or not? Right. And how the company is able to serve the debt. And this is actually very, very important, right? How you're going to be able to pay the debt, service debt, and honor the obligations. It's going to be important. Balance sheet, we already know that. Status of the business at a given point in time. Asset, liabilities, equities, how much the company is worth. The growth aspects of the company. Cash flow, this is actually very important, right? A lot of times people say, well, the income is nothing. I mean, it's just like it's a misconcept. What's the more important to the company is essentially the cash flow. It's not the net income, right? Not just the net income. So, which is cash flow is everything, pretty much. That reflects that attitude. All right, so we know that the cash flow has 3 parts of cash flow: operating, investing, and then investment and financing. Okay. How much cash is generated? What is the ability to generate cash? The capacity to meet financial obligations. So these things actually will be reflected in the cash flow statement. So 10K. For the 10K, it's kind of like the annual report, but it's not called the annual report. Annual report is what? Is the form that you have to distribute to the holders, the equity holders, right? The stockholders. That's required to do that. 10K actually is an annual report required by SEC, right? The U.S. Securities and Exchange Commissions. This is something. So they are different. But some companies actually will combine both of these things, right? They will do the same thing. Essentially, the annual report is like a 10K, right? But supposedly it should be different. Okay, it should be different. All right. this is something actually we had a little discussion during the break, that for oil companies, oil and gas companies, as compared to other industries, the primary asset of the company, O&G reserves, O&G reserves, are not directly included in or on the balance sheet. Now this is actually very important. You really don't see how much the reserve worth, right, is included on the balance sheet, user amount of asset. Remember the example we had for that total asset, the last exam question, right? We're talking about the total amount of asset of the company, and we only included the amount spent on what? Spent on drilling, right? Okay, depends on the method, either $10 million or $7 million to be included on the asset, right? As an asset on the balance sheet. The reserve amount, of course, that could be substantially higher. You may have spent $7 million drilling, but as a matter of fact, the reserve value is going to be substantially larger than the $7 million or $10 million, right? Could be $20 million, but that's not going to be reflected in there. And so you can see here, that's what we said. Chevron's balance sheet in 2000 annual report shows a $41 billion in total assets. But that doesn't include much of their nearly $40 billion value in O&G reserves, right? So that's going to be value. We need to evaluate that differently. And actually, we're going to have a section talking about valuation of the reserves and the acreages, right? How much it should be worth. Right? So we're going to talk about that. Right? So from 10K, you're going to have reserve replacement ratio. We're going to talk about that. What do I mean by that? And what's company's reserve? How much is the reserve worth? And what is the mix? Oil versus gas. Okay, developed under undeveloped. They should have all this information. Okay, and actually they have, for example, yesterday I was looking at Chesapeake's, the annual reports. There's one thing they were talking about reserves or their drilling activities. They listed sometimes, to my surprise, they listed the percentage or number of dry holes as well, like exploration. Now, how many dry holes they've struck? Actually, they have things like that. Some years they may have 1% to 2%. Sometimes it could be as high as 5%. Dry holes actually, and then once they finish the exploration, right, they go into that field development, okay, and in that stage, they also could have sometimes up to 5%, sometimes it could be up to 10% of dry holes, right, which means then that sometimes you say, well, these are the investment wasted, but that's part of the business. You got to have that, okay. So how much is the reserve worth? And the reserve, of course, depends on a lot of factors, or depends on the quality of the reserve as well, right? Okay, what's the reserve replacement ratio? I did that. Okay, I probably should have just deleted one of these bullet points. And what's the cost to replace those reserves? So you can have this information. Okay, so if you look at the 10K report of ConocoPhillips, income statement, how big is the company, you should be able to find out. And this is something I'm going to ask you guys to do. Okay, so the homework assignment actually asks you guys to pick one company, oil and gas company, any company you choose, and answer this question: how big is the company? What are earnings? Earnings in the EPS, earnings per share. I know it's something, right? It's easy, but you can look at 10K. You can look at what? You can look at like Yahoo Finance. Get that information from there too. Okay, I don't really care. We get that. I just spend some time. I want you to spend some, at least read the 10K report or the annual report for at least once, right, for this. So you need to do that. Okay, how much you spend service and debt? Try to find that. Extraordinary items, are there any of these? Okay, you may want to explain, if there's any, just write it down. If the company growing, what happened to the revenue over time, right? So you can look at that.
What is spent servicing debt? What does it mean?
How much you spent servicing debt, how much you paid off the debt.
Oh, okay.
Yeah, how much you basically servicing debt, paid off the debt. Okay. Yeah, David?
Is the 10K report for every company, including, so we can look at any?
If it's a public company, yes.
It could be any company like production.
I mean, okay. It's going to be oil and gas companies. Any of these oil and gas companies. That would be fun. Okay. In the balance sheet, you should know how big is the company, what is the book value of the company, how much debt does the company have, the company taking on reducing debt, the company growing, how about the assets, so whether the company is growing or not. You can look at it from the revenue perspective or from the asset perspective, right? You can do all of these. All right, statement of cash flows. How much cash generated from operation, investment, financing. If you look at the consolidated, financial statements, you should be able to get that very, very quickly. Okay, just grab the number from that. All right. So, the one thing is that I'm going to ask you to attach the financial statements. Am I going to be able to just look for those numbers one by one? I'm not going to be able to do that. Okay, if everyone chooses a different company. So I'm going to trust you guys. Just put in numbers there, and then if you turn it in, you get the credit for that. But I may check, okay? All right, net proved reserves. All right, net proved reserves. And then the oil and gas companies should have these things, right? They should have a table listing the net proved reserves. Okay, what's the total reserve value of the reserves, the current price of oil and gas? Okay, what is standardized measure? Okay, for the standardized measure, if you cannot find it, that's okay. So if you skip that part, that's okay. The statement should have that. What is the reserve replacement ratio? That should have that as well. So the homework is to find an O&G company, answer the same set of questions on page 7 and 8. Attach the financial statement. You might want to email that or just put that on. I'll probably just create a Dropbox. Okay, you put the financial statement. Okay, on that, or maybe just get copy and paste that financial statement or whatever the statement that you used, right? And I think the best thing to do is not just to send the whole annual report. Here it is, and then go read it. Okay, so just try to extract some information from that.
Wait, so answer every question?
Basically, it's pretty much the question on pages 7 and 8. Okay, 7 and 8. You will spend just probably a couple hours.
What do you mean by how big is the company in terms of what?
In terms of income statements, the revenues, what's the revenue, basically, right?
Okay.
I mean, typically when we look at how big the company is, you look at the revenue. Of course, another way, sometimes we talk about the size of the company in terms of market capitalization. Okay, you can look at that, but you're not going to be able to get that from the income statement, the balance sheets, and stuff like that, basically, right? Because the stock price changes. So what is the current size of the company? You probably have to look it up. What's the shares outstanding, and then what is the stock price, right? So you can come up with the market capitalization in that case. So yeah, you can, how big is the company? Also, you can in terms of amount of assets, of the company. All right. Okay, ratio analysis. I'm going to go over some of the ratios here. Now I was thinking about asking you guys to just calculate the ratios. That's probably too much of work. Okay, so I didn't really want to do that. All right, so that's why I said, well, reduce that workload and then to just find out some of the information like that. Okay, so again, the reason for doing that is just go through that, get familiarized with some of the things that we have on the annual report or the 10K report. Okay, and the ratio analysis. Basically, we use to monitor the financial health of corporations. Yeah, we do that. Okay, for example, like a debt service ratio. Okay, the interest coverage. Sometimes they call it interest coverage ratio. And companies do that, especially when the banks, for example, they are lending money to you, right? Making loans to you. They require the companies to have a certain amount of ratio, say 1.5. Okay, 1.5. Okay, interest coverage ratio, for example, 1.5 are required to maintain the ratio of 2. If you get that lower than that, then you're going to be in trouble. Right, you're going to be in trouble. So they're going to make any loans to you. Right, so they do use these things to look at the financial health of the companies. So first, we have several of these. Okay, I'm going to go over this list here, and then I'm going to go into the details of these ratios. Right, especially when we are analyzing companies' financial information, then these are the things we need to look at. Well, there's a related story. I mean, you guys probably paid attention to. The news came out a few days ago, Monday, I believe. Now, the guys who won the Nobel Prize in economics, have you paid attention to that? Remember the name of those people? Probably not. I mean, they are not engineers. So, I mean, the first one is Pharma, right? F-A-M-A, Pharma. And if you study finance, okay, this name is just huge. Okay, Pharma in French typically comes as a pair. Pharma in the French. It's not because he's French. His co-author is a guy by the name of French. Okay, so I think Pharma is from University of Chicago. I believe French is from Dartmouth College. I think Last time I visited Bournemouth, actually, I went to see his office, try to see whether he's in the office, but his door was closed. So, I mean, they have done so much work in the finance. And that's the one. The second one is Lord Hansen. I don't know what he did. That's not important, though, okay, whether I know or not. The third guy is, remember the third one? You guys probably should remember this if you paid attention to the housing market. Robert Shiller. Robert Shiller. S-H-I-L-L-E-R. I mean, if you are, the reason I'm saying that is because there is a housing market index. It's called the Chase or whatever, Shiller index. There's a Shiller index. I mean, I forgot the first part of it. The second part of the Shiller index essentially is the house price to sort of gauge the housing market situation, the asset market. It's one of the asset market situation. So there's three people, and of course, those people have been there for a long time. They have done a lot of important work. The reason I'm saying that is, what they have done, of course, they have done a lot of things. Especially the Farmer and French, they spend a lot of time researching the market fundamentals related to what the company fundamentals as well. We look at a lot of different financial ratios, for example, right, to see how these things influence the stock price. They do that, and also if you look at the general assumption regarding the stock price, and if you look at the, I think maybe it's not on the statement, but also probably it's on the some extensions by some people commenting on these three people winning the Nobel Prize, is that, hey, they basically provided the guidance as to how the stock market is priced. Essentially, according to their study, they said, well, in the short term, the stock price is not predictable. I don't know whether you actually can draw that conclusion exactly. But what they said is, in the long term, yes, the stock prices can be predicted by using some firm fundamentals. Now, what are these fundamentals? There's a reason that's why I'm actually talking about. I started talking about these three people. Okay, these are the fundamentals, the financial fundamentals of the companies. Okay, so if you are trying to find out the value of the company, like probably Warren Buffett does, okay, he doesn't really try to time the market, be the day trader. He doesn't do that, right? What he does is essentially look at the company's fundamentals, and then make the investment decision. So he does look at all these things here, right? He look at all these. Of course, he has his own hunches. He knows that what kind of things he need to invest, right? But he look at the market fundamentals of the companies, or financial market, I should say. This the financial strength of the companies or financial health of the corporations. They do that. So these are typical kind of things that they look at. Okay, they look at. So what are they then? Well, list the ratios. One is the liquidity ratio. That includes mostly the current ratio, quick ratio, or asset test, right? The last one is working capital. We already know what the working capital is anyway, right? But what is the current ratio? We're going to look at that. The second one is profitability ratio. Net profit margin, return on asset, return on equity. These are the things that we look at. And then also others like activity ratios, all right, interest coverage, the one I just talked about, cash flow to long-term debt. Right? Each of these things actually means something, right? So you can look at different aspects of the company. And dividends, all right, so see how the company, of course, some companies never pay dividends, so you really don't have any information on that. Some of the valuation ratios, so got to be careful about those. Price earnings ratio, that's what we call the PE ratio, right, PE ratio. What does that mean? If the PE ratio is high, is that good or bad? If the PE ratio is low, is that good or bad, right? So we need to look at that. We need to understand what the PE ratio is. Price to cash flow. Cash flow and cash flow per share, okay?
When you talk about price here, what price are you talking about?
Price is stock price.
So the price they're selling their stock.
Yes, the price earnings ratio essentially is stock price to their earnings, right, per share. For example, if the stock price is $5.
So you want your earnings to be more than the price you're selling?
Well, but the thing is that the price PE ratio, right? You look at the companies, I'm going to get to the details of that, but basically, what happens to price earnings is not going to be, earnings is not going to be larger than price, usually. I mean, think about why that is the case. Price is what? Price is the discount value of all future earnings, right? You see what I mean? Price is the discount value of future earnings. So if you have earnings $1, Then next period you have earns $1, earns $1, earn $1 each period, right? If you discount it back, to get the present value, right, of that the earnings stream. That usually is your price. That's what we said, right? So you know that the price will be larger than higher than the earnings. So the price earnings ratio will tend to be pretty high, depending on the industries. Like the high-tech industry, price earnings ratio could be as high as 40. What does that mean? That means you are only making $1 per share, right? But the price is $40 per share. It's really, really high, right? I mean, think about some companies, their earnings actually is negative. But what is the price? The price is really high. Okay, so what does that mean? That reflects market perception of their future earning, right? Their ability to make money in the future, right? So a lot of times when you look at this to be high, very, very high, 40, 50, for some industries, some maybe just 10 to 20, it depends on the industry. A high-tech industry tend to have very high PE ratio, okay? So in that case, what does that mean, all right? So we're gonna look at that. Because if this number is high, either it's because this is a low, or it's because this is very high, right? Either one of these. Yeah?
If the company is not making money in the future, and if that's the perception in the market, then no one will buy their shares, right?
If the company is not making money?
Money in the future, like if the people are perceiving that the company is not going to make money in the future,
right,
then they won't buy company's share, right?
Right.
So don't you, that will drive down the price of shares, right? I mean,
the price is going to drop. Nobody's going to buy that, right? The price is going to drop. Okay. If nobody's buying it, everybody's selling it.
So P won't be higher in that case, right?
Oh, if you are talking about, so if I look at the company is still making money, right? But if you are looking at the future, the price is going to drop. But generally speaking, as long as you believe that company can exist in the business, then you're going to have a PE ratio larger than 1. But in your case, if you make that assumption that the company is not making money in the future, then you really don't have a price enough ongoing concern, because when we are looking at the stock price valuation, we're looking at have several things. One of these is that actually we assume that the company is going to produce for a long time, right? If in that case, then it's going to be different. Even though the company may have a little bit of money now, right? But in the future, they're going to lose money. That PE ratio is going to be really, really low. Yeah, but that's not normal, basically. And the company is going to go bankrupt, I mean, pretty much, right, if they lose money. But usually that's not going to happen, typically. Right? If they're making money now, and unless some situation happens, right? If they're making money now, it's not really that bad. The problem is that the company not making money, then that becomes an issue. So, but of course, that could be the case. Okay, so these are some of these things, and then we have energy-specific ratios, such as production to reserve ratio, right? Reserve life index, and production replacement ratio. These are some of the important ratios for the oil and gas companies. Again, as I said, if you look at different books, these things are classified a little differently, but pretty much the same idea. Okay, so let's just look at some of these things here we have. All right, so basically, when we are looking at valuations, we have three kind of things. One is what we call the liquidation value. Liquidation value. So if we are talking about liquidation value, we look at the assets and liabilities to see the net worth of the company. Right? So we are not looking at the company is going to leave for the next several years or whatever. We don't look at that. We just say how much you have on your balance sheet, right? Your assets and your liabilities. Just look at all these things. And then come up with the valuation of the company. So basically, you're going to break out the company and sell off. That's what we're going to do. And then, short term, we use price, cash flow, whatever, EBI, TDA, or the going concern. This is what we were talking about, price earnings, right? Basically, we are saying the company actually is going to be in the business forever, right? How much they're going to make in the future, that directly affects the valuation of the company and also the growth prospects of the company. So we have different kinds, basically. Questions? I mean, the purpose of using these ratios is essentially to compare to the history, right? While we look at that, so you cannot just simply look at, what's the ratio now? and just isolating it. Right? So we really have to look at, compared to the history, compared to other companies in the industry, compared to the industry average, compared to the index, we all, like PE ratio, what's the overall, right? Compared to those things. That just gives you some kind of idea about how the company is performing. All right, the ratios. Looks like the ratio here. First one is the liquidity ratio. Okay, liquidity ratios. I check the solvency of the company. That just means whether the company has generated enough money, right, to do what? To pay the debt, pay this liability, the short-term liabilities. Okay, so first one is called the current ratio. Current ratio. It is what we call the ability of the company to pay short-term obligations. So the current ratio is just a ratio of current asset and current liabilities. Right? So now these numbers are just grabbed from the companies, say for example Chevron, before their merger with Texaco. Okay, so the ratios are this. Okay, like that, and then after they merged, and the total asset amount, the total liabilities amount actually changed a little bit. There are some reasons. Okay, there were some reasons. So why there's a decline in the current ratio? I forgot. You can try to find it. But okay. So typically, the oil and gas companies, right, have a little bit higher current ratios. Fairly straightforward. So obviously, what we want to do is to have a higher, right, current ratio. If you have a higher current ratio, that just means then you have ability to pay the short-term obligations, because the current liabilities these are short-term, right? These are short-term. Current assets. Now, what are including the current assets? Do we have anything here? Well, anyway, yeah, we have here, right? What are including the current asset? Cash, right? Of course, you can use that to pay off any debt. The marketable securities, that's the current asset, right? The receivables, you're going to receive that from the company you sell product to, inventories, all of these. So you can convert this relatively quickly into cash, right? So you can use this to pay the short-term debt, right? So this is very important. If you have problems with this current asset, then the company is in trouble, right? It's in trouble. All right. Okay, working capital, we know that. What is working capital? So, okay, profitability ratios. Profitability ratios. One is net profit margin. Right? What is net profit margin? Is defined as earnings divided by sales. Right? Defined by sales. Profit margin. This is the thing that people always talk about. Okay, right? Profit margin for some companies is pretty big. For some companies can be kind of low. Right? Net income, total revenue, and other income. Sometimes it's called the return to sales. Return to sales. Return on asset, return on investment. That measure companies' profitability relative to total assets, right? So the return basically is the net income. Okay, it's net income, and then the total assets in the denominator on the bottom, right? So per dollar invested, how much income you have. Return on equity, that's only on stockholders' equity. Right, not including the debt, not including debt. All right, I think that's something we have talked about. Here we actually have a few numbers there. All right, especially for the top parts, right? We have our return on equity and return on asset by different industries, right? I mean, the oil industry and the sectors, basically. We are talking about sectors, shouldn't be by industries, but actually by oil and gas industry sectors. Integrated oil and gas companies, right? It's like they have, the ROA 7.6 in general, okay, in general. And these are some of the typical numbers, right? Typical numbers. So they really do not differ that significantly. And the drilling, actually, return on equity is relatively low, right? It's relatively low, only 11.1. Okay, and also their return on asset is relatively low as well. It's only about 6.7, right? 6.7. So it's the lowest, almost the lowest drilling problem involving large amount of risks. We don't have to worry about too much about the return on invested capital. Okay, invested capital. All right, so activity ratios. To see what we mean by activity ratios, the interest coverage, right? So basically, whether you're going to be able to service debt, right? Service debt, interest coverage of companies to pay, to meet interest in the principal payment on that. So it's defined as pre-tax earnings plus interest. Pre-tax earnings plus interest divided by interest. This is how we, this is standard measurement, okay, standard measurement. So at a ratio less than 3 begins to indicate a higher degree of risk. Of course, you can say, why do we use pre-tax earnings, right? And if you use the after-tax earnings, then that ratio number shouldn't be as big as a 3, right? You can use that, right? But pretty much that's kind of standard. Just look at it. Interest rate charges are high compared to profit. The company is highly leveraged, right? So we know this leverage is just what I mean by high leverage. Leverage just means you have a higher percentage of debt, right? Higher percentage of debt. So it's the leverage amount. Okay, if the company has major long-term capital lease obligations, okay, or other contractual long-term obligations like fixed charges, the fixed charges is what we call the long-term obligations, other contracts, you just have to pay that, right? So you should include that. So you kind of have the fixed charge coverage. So I have an example next to see how we actually can calculate these numbers, these ratios, right? So interest coverage, pre-tax earnings 100, let's see here, okay? And the interest is $10, fixed charge is $20, so the other obligations, all right? So the interest coverage, that should exclude the fixed charges. So that'd be 100 plus 10 divided by 10, so it's 11. So you actually have a pretty good interest coverage, right? Interest coverage. And that just means you have enough money actually to serve the debt, okay? Serve the debt, right? Pay the interest, right? Of course, the U.S. government has a problem. Okay, so just have to keep borrowing, right? Keep borrowing and then pay, borrow and pay, borrow and pay, and borrow and pay. It just doesn't generate enough income to cover that. Actually, there's no. We typically just have a bunch of deficit in the way. All right, the fixed charge coverages, you have to include the fixed charges in the denominator as well as the numerator. So you include that in there.
That pre-tax earning, is that the earnings before interest and taxes?
Yeah.
Okay. So instead of subtracting interest, you add interest.
Yes. Yeah. So that's pretty much how much you have made. I mean, in terms of the the incomes. So you can use that part to pay off the. That's the reason. For example, one of the things that you might argue then is, why don't we just use what? Use the net income, right? Because that net income, or use cash flow, for example, right? Use cash flow. The cash flow represents the amount of money you actually have, right? The cash you have to pay off these things. You can do that, right? But here we just simply use the income. Yeah.
I'm just wondering whether the pre-tax earnings is the same as the revenue.
Pre-tax earnings is that the same as revenue? No, it's not the same as pre-tax earnings. Earnings is the income, right? Earnings is the income is after the expense. Pre-tax revenue, pre-tax earnings is pre-tax income. So basically, it's already revenue minus the costs, expenses, okay, not including the interest. So, well, actually, pre-tax is already deducted the interest in that case, right? Pre-tax. The only thing we don't have here is essentially the tax expense, right? Tax expense still in there. Okay, guys. All right, cash flow to long-term debt. Okay, so cash flow we have to the long-term debt, and we have DD&A, right? DD&A is going to be in there. Okay, just look at that DD&A. We know these are non-cash items, right? Non-cash items, so that we need to put that back in there. Deferred taxes. Now we're going to talk about deferred taxes later on, and this is still kind of an amount you actually have. You haven't really paid yet. Right? We're going to have examples looking at that. Right? So. And also exploration expenses, right? So divided by long-term debt. Long-term debt to equity, long-term debt divided by stockholders' equity, right? You see, basically, again, we're going to have a number larger than 1, depends on the industry. Sometimes you have a multiple, the value larger than just 1 or 2, depends. The higher, the better, of course. Activity ratios, again, talking about net income excluding taxes, interest and depreciation and amortization. Right? So whether you actually have enough income, right? The profitability basically of the profitabilities, right? Dividends, okay, dividend yield, the percentage of dividends, right? The percentage dividend to, versus that stock price, for stock price, we know that. Okay, percent of the income distribution per share of stocks. Sometimes people look at that. And for long-term investors, they probably don't care too much about a dividend. As long as the company keeps that return earnings for their future growth, then that'll be fine. Right? You don't just look at that. So it depends. But again, if you don't pay dividend, they actually use that money for the future growth. That's fine. But for the utilities, they pay a lot of dividends. Right? They don't really retain earnings for the growth because you just have to generate enough returns on equity in order to carry out the usual business. Everything's pretty much set in that case. Okay, dividend payout ratio or payout ratio. So that's pretty straightforward. That is, what percentage of your earnings will be paid out as a dividend, right? That's what I meant by the dividend payout ratio. So that equal to the annual dividend rate divided by earnings per share, okay, earnings per share. Right, the annual dividend rate is already divided by the number of shares, so it's on the per share basis. So both these terms actually, these two terms actually, both of these are already on the per share basis, right? Already on the per share basis. Okay. Net income, suppose, for example, we have $20 million. The shares outstanding is 2 million. Then the dividend would be equal to $5 per share. Suppose dividend is equal to $5 per share. Then the payout ratio is $5 per share, and then divided by what? The earnings per share, right? Earnings is net income. Okay. So we have $20 million divided by $2 million. You have earnings per share of $10. Okay. So basically, you have 50%. So the payout ratio is 50%. So basically, for a company, it makes 20 cents a share, right? It pays out 10 cents if we have 50% payout ratio. The company retains 10 cents. So that's how much actually the company is going to keep. All right. Measures how well earnings support dividend payments. All right, so that's then the dividend kinds of calculation. The valuation ratio, the PE ratio, valuation. Why do we call it the valuation ratio? Because these things involve the stock price. Okay, involve the stock price. That's why we call that valuation ratios, right? Well, the PE is the price of the stocks. Okay, what do you mean by PE? It's price to earnings ratio, right? Stock price per share versus earnings per share, right? That is, the one share is making this much money. How much that's going to be reflected in the stock price, right? This is the most, one of the most widely used ratios. Okay, this can reflect the investor mood or optimism. What do you mean by that? Why we say that PE ratio reflects the investor's mood? I mean, a company, for example, is still making, which we're looking at this hypothetical situation, that the company is making $4 per share. Okay, $4 per share. But then the price, PE ratio, and PE ratio changes, right? Stock price changes, okay? Maybe the company is still making the same amount of money in that case. The PE ratio maybe is 20, and some years may become 5, right? Why is that? The company is still pretty much the same, okay? But all of a sudden then, when people feel so good about the company, the prospect of the company, then the price is going to be high because everyone's buying it, right? Everyone's buying it. So if you are optimistic about that company's performance, the price is going to be higher. Otherwise, the price is going to be low. That's what we meant by that. So if you are looking at the PE ratio of a particular company, you really have to factor in a lot of those factors. Okay, it's not just because the earnings are higher, so or the lower. I didn't probably say it right. Okay, it's not because that the company is doing really, really, really well. Okay, not necessarily. Right? Currently, a company may not be doing really, really well, but the PE ratio can still be high. That's because people view that a little differently. So it may reflect anticipation of future earnings. This again is very typical with respect to the high-tech industries, right? High-tech industry, because at this point here you don't make money, right? but in the future, the company may make huge amount of money, right? So, but the oil and gas industry, typically we don't really see that unless that you really believe that the company has a lot of potential to find a major reserve, okay, major oil reserve. In that case, then you could see that the PE ratio can be substantially high, okay, can be pretty high. And also, this one says here, last bullet point says that the OG&E companies, okay, O&G companies respond to oil and gas prices dramatically. That's of course is understandable, right? Understandable, because the value of the company depends on the price of oil and gas. All right. Okay, let's see here. What's the next one? Price cash flow. We started for about 40 minutes, right? Okay. 50 minutes? 40 minutes, something like that. I took that. Okay, 50 minutes. Want to take a 5 minutes break?
Yeah.
Yeah, I feel like you guys just fell asleep. So when I look at that, I want to fall asleep too. So, okay, let's just take a break. 5 minutes, not long.
So the homework 4 is in the presentation?
I'm sorry?
Homework 4 is in the presentation?
Is the presentation?
Yeah.
In the presentation?
It's the homework 4 in.
That's homework 4. I think that's homework. Yeah, it's in there, right?
Yeah.
Page 8.
So that's it officially? Okay.
So that's all we gotta do. Just pick.
It's a lot.
You know what? It could be, it could spend some time on that.
Yeah, it's
So,
a lot of work.
Yeah, it could be. Just read through that. And one of the things you probably can do is like, if it's PDF, right? You do a search.
Yeah.
And you can jump to that point.
You want to just drop in the Dropbox? Is that the way you want it, or do you mind if it's turned into paper?
It doesn't matter. It doesn't matter. Yeah. You don't have to put it in the Dropbox. Paper.
When is that due?
I think I said something like Friday. A week from tomorrow. I mean, so from now, if we have homework, what we're going to do is essentially have the homework due the Friday of the next week. So if you have questions on Thursday of next week, we can talk about it. All right, instead of just due on Thursday. Okay, let's see here.
Just say it was the best time.
Yes. Oh, there's let's see here. And we ready. Okay, it's almost 5 minutes, right? 5 minutes goes really fast. Okay, we'll get started. We'll get started. Then, all right, let's see here. 1, 2, 3, 4. Okay, we'll start it. I have something here. I mean, one of the things that I did this is basically, hey, let you guys have a break and then try to pull up something so we can do that. All right. Okay, just look at this. I mean, just look at the finance.yahoo.com. They actually, I was trying to pick a few things. For example, like Devon Energy, right? Devon Energy. Look at all this basic financial stuff here. Just a few of these things, right? The beta is 1.72. It's pretty large. But one of the things I want to point out here is the earnings per share and then PE ratio, okay? Dividend and the yield as well, okay? Say the earnings per share for Devon is actually what? You probably cannot see that very clearly, right? It's negative 4.3. Why is that? Because they actually had a lot of write-offs last year, I believe, from 2012. Okay, they had a lot of write-offs, right? Thought I had it. Maybe it's there. Yeah, Chesapeake. Chesapeake is the same thing. Look at Chesapeake, and the earnings per share is negative 2.18 because the write-off as well. Right? It's because of the oil price change, gas price change. They had a impairment. So a decline. I mean, they did not calculate the PE ratio because in this case here, the PE ratio doesn't make any sense, right? I mean, price divided by a negative earning, what does that mean, right? It doesn't mean anything. So they don't have it. But then what I did was just look at the Citigroup. Just look at one company. This is, of course, the banking industry, right? And then the earning per share is $4.02, okay? Earnings per share is $4.02. And the price is $51, about $51 at this point. So the PE ratio is about 12.72. So the banking industry, roughly, the PE ratio is roughly in that neighborhood, around 10. Okay, around 10. So each industry will be a little different. Okay? I mean, let's choose one, the high-tech industry. Okay? Anything? High-tech industry? Apple? Well, actually, it's pretty much the same. 12 point something. Okay, it's not very high. Do we have any company that's gonna? Microsoft. Microsoft is Microsoft Corporation. It's 13.53. So for the mature ones, you usually don't see that to be pretty high, right? Do we have any newer ones? Guys probably paid attention to the IT stocks, or maybe oil company stock is kind of new. Maybe people have a lot of hyper, expectations. Think about it. Oh, this company is going to make huge amount of money, so everyone's buying it. You guys know any of these companies? Huh? What's that?
Oracle?
Oracle? I think this probably is not going to have. No, what did it do? No, I did not. Should not use that. Look it up because Oracle 14.13. So it's still not that terribly high. We're talking about some company to 20, 30.
Facebook.
Facebook.
Yeah, it's very high.
Very high.
Yeah.
Facebook. FB. Yeah.
That's ridiculous.
2036, right? Earnings per share is only 22 cents a share. Okay, so not much, and the price is just 51. So in this case here, the high PE ratio. Now, what does that mean? Clearly, in this case, that reflects the market's perception that they're going to be able to make a lot of money in the future, right? Okay, whether that's going to be true or not, you have to bet. Okay, you just have to bet. I mean, investing for certain particular companies is like a gamble, right? Overall, you actually can do that pretty well, right? Diversify, because overall the market will go up generally, right, over time. But then, in the individual companies, well, sometimes you never know, right? Because it could just go belly up, or they don't generate enough cash or revenue as according to you expected. Then the situation will just change dramatically, right? So this Facebook is one. Yeah. All right, I think that should be enough. Now we're talking about one company going IPO. It's a game company. What's that game called? There's a name, I think, Candy in there. What's that? What's the #1 game?
Grand Theft?
Sweet Candy?
Oh, Candy Crush.
Yeah.
Candy Crush. I'm addicted, so.
You're addicted to
Yes,
that. So is my daughter.
It's so much fun, though.
Really?
Yes.
I never found that to be fun. I don't know why. And they were talking about an IPO of the company, right? I think so. So, you know what? Should you guys buy? I think I'll probably buy some.
I would buy it.
I mean, you know, a lot of times it's based on that, right? And for one thing, like, you know, say, Domino's Pizza. How many people actually like Domino's Pizza compared to other pizza? Only one? No, you actually just drop your hand just immediately. Did you see anybody else raise their hand? Okay. I like that better. At least it's better than the Sam's Pizza, right? but you know, the company's doing really well. Because I think it's because a lot of people like it. You know, that makes a whole lot of difference. And there's one guy, you know, my friend, who bought, I told you guys probably once, right? He bought Apple's stock at the price around $3, $4 at the time. Of course, he was a millionaire so many years ago, okay? Actually, he bought a lot. So nowadays, he doesn't have to work if he needs the money, right? Just sell a few shares to do that. He bought that. Why he did that? The reason he bought that stock is because he really liked the product. He really liked his family. So from that time on to now, all these are Apple products. Just loved it, and you know, everyone just loved it. You know, that sort of drives people's, you know, the purchasing behavior. I mean, if you really like it, hey, there's someone else that's probably just like you, right? Will like it. So, Candy Crush?
Yeah, Candy Crush.
Okay, buy some then. I don't know what's going to happen. Well, they don't.
I mean, they're making a lot of money because you can pay for in-game purchases, and you don't know before you click something and you spent like $5 on it. It's really good stuff.
Yeah,
bad stuff, but good.
Yeah. Do you actually pay money to play those?
That's how they get you. It's free to play, but while you're playing,
once you get addicted,
yeah, exactly.
Then you just have to pay money
to keep doing it.
Okay, so. You think that $1 is not much, right?
Yeah, and it's 99 cents. You're like, it's 99 cents, but then you do it like 5 times. You're like, crap. So. Yeah.
For that reason, definitely need to buy that stuff.
I know.
Yes, yeah. I'm sure you're gonna get higher payoffs from that. You know, so yeah, keep playing that game. 99 cents only. So. All right. All right, price to book ratio, price to equity ratio. Again, the same thing, just like price to earnings ratio, right? So basically, the stock price per share, book value per share. And a low price to book value can indicate an undervalued stock. Okay, it's just like something like this, right? What I said before, PE ratio. If you have a very low PE ratio, that might indicate that company is undervalued, right? Undervalued. So you might want to buy some of these, but of course, you know, there could be a lot of different reasons. Okay, there could be a lot of reasons why the company actually has a lower PE ratio, right? So, you know, this could be undervalued. It may not be undervalued, maybe because the company is not really doing well. So the market is not really look at that favorably. So that could be one problem, right? So it could simply reflect investor mood. All right, energy ratios, some of the energy ratios. Specific to extraction industry, so we look at the production to reserve ratio. Right, so is that good or bad if you have high production to reserve ratio? Basically what we are saying is what the company is replacing reserves that are being depleted through production, right? Now if you have a high production to reserve ratio, that means you're producing a lot of these, right, out of your reserve. There could be a problem, which means that you're not going to have much to produce in the future, right? What you're going to do better to replenish the reserve in that case. So you really want to have a higher level reserve. So to start to reduce the amount of production reserve ratio.
So is it better for it to be lower than 1 or 1?
If it's lower than 1, it has to be lower than 1, right? Okay, if you say, think about that, the production, you know, that ratio there, okay, if you're talking production reserve ratio is larger than 1, how many more years are you going to be able to produce, right?
No, well, what if it's, so 1 is still not good enough. It has
it's not good enough. If you have 1, that just means next year you probably don't have anything to produce, right? Because you are essentially, you know, exhausting all the reserves you have. Just 1 year's production, that's it. And then you're going to close your doors. So obviously you don't want to do that, right? So you need to really keep finding reserves, right? So that's very, very important. If you don't have reserves, then it's a problem. Okay, just like sometimes we call it backlogs for some companies, right? If you don't have the backlogs, that just means if you finish the current, you know, job, then you don't have any more jobs to work on. Okay, you don't have any work, you know, to do. So I know that because, you know, for our companies, and that is very important. How high is your backlog, right? If your backlog is really low, the managers better go out there, all right? Try to get some work. Otherwise, what happens if you finish this project, then everybody's sitting there idling, you know, have nothing to do. So it's kind of the same idea, right? Well, anyway, so 10K reports, net proved reserves. You have all these things. You have production reserves. You have all the, right? Reserve life index. Okay, this is the you know, the reverse, or I should say the inverse of the production to reserve ratio. Okay, so 1 over production to reserve ratio. So for example, if production to reserve ratio is 0.1, okay, 0.1, essentially each year you produce 1/10 of your reserve, right? So the RLI, okay, reserve life index is 10, right? So which means that the reserve will last about 10 years for you to produce at the current rate of production and reserve finding. Right? So if you don't have additions to reserves. All right. So large RLI is not always a good sign, since it may indicate a lack of development. What I mean by development is just like you have found that reserve, right? You just haven't developed it into, so there's no way you are producing it. Right? So you do that first, you know, exploration, development, and then production. Right? So, okay, energy ratios. Production replacement ratio is the increase in the reserve plus production divided by production. Okay, so that measures what? It measures whether the company is replacing the production, whether the company is increasing reserve or depleting them. So you can look at it. Especially you can look at the historical movement, right? Compared to the past, you can get a lot better idea. All right, sometimes ratios can be misleading. So this example actually shows that the ratios may not be something very good. By looking at that, you may get a better idea, right? So example is this. All right, so corporate management can take certain short-term actions to influence their ratios. This is what we call the window dressing. All right, so look at the example. The current asset is 150, and current liability is 100. So the working capital is 50. All right. The current ratio, what's the current ratio according to that? Is 1.5, right? The current asset divided by current liabilities, so that's 1.5. But if you pay out $50, then your current asset is going to be decreased by 50, right? You use that $50 cash to pay off the debt. So then you have $100 current asset. But the current liability has been reduced by 50 as well. So what happened to your ratio, current ratio? Your current ratio becomes $2, right? What does that mean? That means actually you have more cash, looks like, right? You have more cash to for meeting the short-term obligations. But actually, that's not really the case here, right? The total amount of working capital you have is still the same amount. It's still 50. The working capital in this case is still 50, right? In the first case, it's 150 minus 100. Now it's 100 minus 50. So the working capital amount is still the same, which means the company situation hasn't really improved, right? But on the paper, it looks like hey, it's improved, right? But it's not. So that's what we meant by the window dressing. Looks better, but it's not. Okay, so the most important user ratio analysis are, evaluate the leverages when we know how much debt they actually have, right? Leverages the screen companies or stocks. Evaluate the ability of the company to meet interest and principal payments, debt service capabilities. So this is very important. Okay, debt service capability. Okay. How much is too much debt? Right, so if leverage too much, okay, greater the percentage of debt, the greater the financial leverage, right? So it depends on the industry. Oil industry tends to be about 40%, okay, 40% debt. If you have higher level of debt, then the cost of borrowing the debt is going to be a little higher, right? So that's sometimes substantially higher. But the higher the debt, the higher the risk. That's something the point that we pointed out before, right? So a lot of risk. And the banks actually do the same thing. If you want to borrow money to finance your real estate investing, for example, right? And the banks wouldn't really lend you that much if they just have a certain amount, actually, they look at that. And then if they exceed that amount, they consider it to be very, very risky. Either they have to raise the interest rate, or either they just don't lend that to, right? They don't lend that to because they don't want to take on that much of the risk. So leverage, it has a little problem, okay? It's a little problem. And remember Donald Trump, right? Donald Trump in the early 80s, okay? And one of the things he did was to essentially have a very high level of leverages, right, to, in his businesses. What happened was, of course, he filed bankruptcy a few times, right, because he came down to the point where he wouldn't be able to pay off the debts, okay? He wouldn't be able to, just highly, okay, leveraged. So that could be a problem. And this is the reason why Dave Ramsey, right, if you guys listen to the radio, Dave Ramsey show, anyone? Okay, sometimes, I do that whenever I can, just on the way, home. It's happened to be during that hour, so I just listen to it. It's kind of fun to listen to it, actually, to see how they answer different questions and see how people make some kind of mistakes I want to avoid. I don't want to make that. Typically, I don't make any of these mistakes, by the way. It's just obvious, right? The non-nonsense thing. Okay. But the thing is that having debt sometimes can be considered to be very, very dangerous, to be too problematic. But I don't really like the David Ramsey's idea of not having debt at all. I think that's not really a good idea. But I understand why he proposes having no debt at all. And remember his approach, right? Is essentially retire all the debts, just to pay back all the debt possible, as much as possible. You do that, okay? Even if it's on beans and rice. That's the term that he like to use, right? I really don't like that. I think that's not the way to it's the modern society. But I understand why he's doing that, because I think some people simply cannot control, right? So that is the purpose. So you really have to do that. But if you know what you are doing, then you should have a certain amount of debt. Otherwise, hey, using someone else's money to make money, that's the true way of making money, basically, right? I mean, this is how the modern finance is based on. Maybe, quote unquote. I said that. Okay. All right. Okay, so the percentage of debt is not sufficient. Of course, we need to look at the company's debt service capabilities. You borrow a lot of money, but if you can pay for it, right? Pay the debt, that's not a problem. If you really can't pay, that becomes an issue. All right, the company should be able to cover interest and fixed charges by at least a factor of 2, or more comfortable coverage would be 3.1. So what we are talking about here is the debt coverage ratio. Okay, the debt coverage ratio. What does that mean? That means then you generate enough income, okay, to cover the debt. In this case, typically companies use the income, right, plus interest, right, basically, not the cash flow, right? They just use the income. Then divided by the amount of interest or the fixed charges. And then 3, if you have 3, this actually is pretty high actually. 3 is pretty high. Now one of the things that actually is last few weeks that I was looking at, I was calculating the cost of debt and the cost of equity, and basically the cost of capital for one of the utilities. And then I was looking at the documents, all these kind of statements from the past. Basically, the requirement by the banks that actually lend money to that utility. One of the requirement was the debt service ratio. Right? I was looking at that. Actually, the company didn't. I mean, the bank did not really ask for a very high level of debt service ratio. Okay, they only asked for about a 1.3. That just means if you can generate this much of the income to cover your interest payment, right? They only require 1.3 to do that. I mean, according to this, I mean, of course, you need to have at least a factor of 2, right? In that case, it's only 30% high, right? 1.3, that seems to be pretty low, okay? So, then I was looking at that. I think there's the reason, because at the very beginning, the company wasn't able to make that much money, so they actually were willing to lower that ratio. But gradually, they probably just raise that. But, actually, according to the rate we calculated, the company would be able to raise that best coverage ratio or service ratio to about 1.75, which is a lot better than the requirements of that 1.3, under the new tariff structure. All right, anyway, so next one, example, assume two companies, X and Y. Let's see here. I think this example will try to show that there's a little difference though. One company borrows 50% of the capital. Another company doesn't borrow anything at all. In that case, return on equity, return on asset will be a little different because there's a what? There's a interest. There's a tax payment involved in there. So let's just look at an example here. It's a little bit small the fonts. Okay. All right. So from company X actually borrows about 50% of the capital. So the invested capital, the equity amount, equal to 500, and the borrower capital is 500. Company Y doesn't borrow at all, right? So all these things are equities. The total amount of capital for both companies are $1,000. After tax return, okay, before interest expense, 150 for both companies. But then, since this company borrows the money, right, debt, I have to pay after tax interest expense, $33, right, $33. So the after tax return with after tax interest, okay, is 115, okay, 113, okay. For this company here, 150 after tax return. Right? So the interest actually made a difference between these two. I think I made some assumptions about the interest. Tax rate is 34%.
After tax interest expense, isn't interest usually taken before taxes? So are you saying that interest?
Yeah, that's the expense that you're gonna have to deduct, right? You can calculate
after taxes. So it's okay.
Yeah, well, this is calculate. I think the reason I did here is try to show that that interest expense actually is one of the expense you're gonna have that.
Because if you take out interest before your taxes, it lowers the tax you have to pay.
Right.
So, but if you're just taxing yourself and then taking out interest expense after tax, you're paying way more.
Okay, let me see here. All right, after tax return. Well, there's one purpose I did this. I guess the reason I did, put down something like the after tax interest expense. This expense is the other amount, the interest. Let me go back. Okay, so let me try to see how I can explain this. Right, the reason for that is, both of the returns are, if you look at the returns here, right, both earns 50% rate of return on after-tax invested capital. After-tax, 15%. I'm kind of lost here. If you guys see something, okay, try to give me help. I forgot how I did that and why I did that. Let's see. We had a 15%, okay, after tax return, after interest expense, 150.
Have you accounted for income tax? I don't think you have accounted for income tax till that 170. I think income tax will come after 170.
170 income tax. After tax return, so we don't have the income tax in here. What are we talking about? It's supposed to be sort of, yeah, this actually should be the whole thing here. 7%. Yeah, I think 7% should be enough. Once we run out of this battery, then it's time to go home. I don't know how long 7% is, okay? Maybe an hour. Okay, so this after tax return with after tax interest expense deducted. Is this last slides? Not really last slides. So what we're going to see is trying to understand the returns, total amount of capital. Well, the thing is that we don't have any income thing. That's the point here. You know, so you really cannot calculate the after-tax income, whatever, right? Okay, so
it's just doing the 15% on the
yeah,
capital.
Yeah, this is what it is. I mean, look at these two numbers here, 150, right? It's just 15% on the total amount of capital, okay, before interest expense, and after-tax interest expense. Man, I just can't seem to remember exactly, but maybe it's because it's getting too late. Yeah. Let me look at this one here, okay? A couple more examples. You know what, let me just come back to this example. Come back to this example. That would be better. And instead of try to figure it out, I try to get this back to you next time. But let me just try to finish up the other ones, and that's it. I think the 7% should be able to last enough time for this. All right, another ratio example we have the balance sheet here, assets, liabilities, and owner's equity. Okay, so I guess what we are trying to do is try to calculate the, let me go back here, okay. That's based on, yeah, that's just based on that information. Okay, let's just go through that, all right? So I guess this example will try to show some of the ratios, some of the information we can have by looking at the balance sheets and the income statements. Okay, we're going to be able to look at that. Well, we're going to get back to these two slides, but let's just jump to the third one afterward. How big is the company? Okay. Now, when we said how big, we can look at the company from different perspectives. We can look at the company from the asset side, and look at from the capitalization, from income, right? From a lot of different things. Right? So, total asset. If you look at that, for total asset, we can look at the total asset from the balance sheet case. You know, you have 29250 or 30420, 432, right? So that would be something we can conclude. All right, total asset, we can have that. Total earnings, that will be an indicator of how much the company, how big the company is. All right, so, and also capitalization. The 7% is pretty short. Yeah. I didn't do anything. Come back to life. Okay, I didn't do anything, okay? So, I think this, okay, I think we still have a few minutes. Let me just try to finish this. So basically what it could do is share standard suppose of 1,000. The EPS, actually this can be calculated by looking at net income, right? Earnings, right? Earnings. So we actually have this much of earning, and then multiply, divided by total earnings this much, and divided by the total amount, the shares outstanding to get a EPS. Okay, so that's what we can get, just by utilizing information from the income statement. How much debt we have? The debt is 858 plus 5,000, so you have to go to the 858, that's the notes payable, right? Notes payable, that's the debt. Accounts payable, that's not the debt, it's the short-term debt, notes payable. And long-term debt as well. So you add this notes payable to the long-term debt, that is the total amount of debt, okay? So that's the debt. Okay, next one, company take on reducing debt. Well, what we can do is look at the short-term debt, 826 to 856, all right? So what we can do is look at that 826 to 856, so the company has to reduce the amount of the debt by looking at that, right, short-term debt. Reduce from 858 to 826. The long-term debt, if you look at the long-term debt, increase from 5,000 to 2. This is a net amount. The company might have made an investment, might have sold assets or whatever, right? But this is the net. So generally speaking, in the long term, the company's debt increased. All right, cash flow. So you just have to use the usual way, that is the net income 8006, depreciation, we have that, and then the asset or these liabilities, that's the working capital basically, right? This is the increase in the current asset plus this essentially is a minus that increase in the current liability, that's a change in the working capital. So this cash flow utilize the information from both the income statement as well as the balance sheet to calculate that. I mean, this is stuff that we have done that before. Some of the ratios, okay, some of the ratios, we actually have a couple of ratios. Current ratio, by using the current asset divided by current liabilities, you can calculate that. Quick ratio, working capital, and profitabilities, and all these things. I think just grab these numbers from these things here. Okay, we can calculate that. I mean, jump around, it's hard to see that. Okay, but I think you guys might just want to look over these things, try to find out, these things are where to get these values. Interest coverage and cash flow to long-term debt to verify each of these numbers, right? So I probably should have done things a little differently. Maybe just have these two on the same slides and then put on the board and what these things are. But I think you should be able to get that very easily, and there's numbers should be corresponding to each of these things we had before. Dividend ratio, okay, basically this is the total amount of dividend, 6148. If you look back here, dividend, right, 6148, okay, and then the total amount is 8006. So you could see that the dividend amount 61486 out of 8,006 net income. So the dividend payout ratio is about 77%, right? Price earnings, we have price information there. We have earnings ratio here, okay. Then you can get the price earnings. You could get all this information, right? Get the information. I think that's probably the last slide. I don't know what happened to the computer, going over to that side.
It was a sign.
That's the sign, yeah. Let me see here. Where's my battery? I don't know. Oh, here. Battery. 0% remaining. It's amazing. 0% remaining. Computer still works. So, okay. I guess I'll see you guys next Thursday. All right. Enjoy your week.